The biggest one I had ever was 732,000 in 1 month.
Wow.
That was also the same month we had our biggest one ever, that $317,000 client.
The student loan crisis situation with new students, is that getting better or is that getting worse?
People do use the student loans for other things besides education.
What are some of the risks in doing that?
That's a good question.
With these bully tactics, are there any protections for borrower in situations like that? If they are aware of hey, you're doing XYZ thing, this is illegal.
The validation scam we were talking about, where you send a couple letters and say, I'm going to get your debt deleted with a couple of validation letters. Those kind of people, some of the credit repair scams, which they can do that on social media and get away with it.
How long is it on average before they actually get to a point where needing to go to a court, if at all?
The major risk is
Welcome to today's episode of Getting to Know You. I'm your host, Cameron Edward Benton, and on today's episode, I have the great pleasure of introducing you to Andrew Weber. Andrew is a student loan negotiator, specifically with private student loans, and we originally met because he helped me settle my student loans of $65,000 for 40%, which was about $23,000 or so in total by the time I was completely done with that. And it saved me a huge ton of money. I mean, not even counting interest over the next, 20 or so years that it would take me to have paid that off. And he does that with a lot of individuals. And he has a really fascinating perspective on the entire student loan industry. Plus, I wanted to have him on there so that he is available to help you. If you are someone who has private student loans, if you're a co-signer of someone who has private student loans, if you know someone who has private student loans, Andrew is an incredible resource to help navigate that, pay a fraction of what you might owe after you've already probably paid more than your fair share in, ridiculously high interest rates and all the other things that come along with these things. That being said, in this conversation, we do go over a lot of financial stuff and legal stuff. None of this is to be taken as financial or legal advice. This is for education and entertainment purposes only, as they say. With that, one other thing to mention is that we recorded this episode in 2 parts. So if you notice a little bit of weird lighting things, we might take a couple pieces and move them around just to make the episode a little bit more coherent from beginning to end. We did that because we recorded it and I thought we had gone for about 2 hours when we had actually gone for a little over an hour. And I wanted to dive more personally into Andrew. And I thought we just ran out of time, didn't have a chance to do that, but we were able to do that in the second half. So if you notice any weird stuff with the video, in particular, if you're watching this on YouTube, apologize for that up front, but that is the nature of this beast. So without further ado, here is getting to know Andrew Weber. Andrew, who are you?
Hey Cam, I am a certified credit counselor and a certified student loan counselor, and I specialize in negotiating private student loans. Been a debt negotiator for about 15 years and really happy to be here today.
Yeah, I'm excited to help you on. And just so the audience knows, Andrew and I actually worked together. And the reason that we found each other is because I was looking to settle my own private student loans, which were around $65,000 at the time. And Andrew helped me settle those for, I think, 40% or 45%. Do you remember the number correctly?
I think it was around 40. Yeah.
Yeah, which was, astronomically low. It basically saved me 60% on the payment itself. And that's not counting the long-term, paying all the interest over time, which I think when I calculated that was well over $100,000. So you saved me probably about $125,000 over the long haul through that process. And so I wanted to have you on because, the work that you did for me, and I think the work that you're doing out there is so important for people to know, because especially with private student loans, there's not a whole lot of options out there, which I'm sure we'll get into
Right.
to actually get out of this situation. You can't do, I forget, what are the types of payment plans that you can do through with the federal loans, like the
income driven plans. There's no income-based payments for private student loans. I tell people, if that existed, you would never hear about me because I'd be out of business. Mm-hmm. So there's really only, I would say, 2 major options for private student loan borrowers for the majority of borrowers. So bankruptcy is still, student loans are still exempt from bankruptcy, even if they're private for the most part. There are some loopholes around that, but it's not available to the majority of people. So for everybody else, it's really it comes down to settlement or refinance. So settlement is like what we did with you, where we're settling for less than the full balance, either in a one-shot payoff or a structured settlement over several years. Then refinance is just getting a lower interest rate with a different lender. And those rates are a little high right now, like the fixed rates are, but the interest rates on private student loans in general are, I mean, it's a crisis right now. We have people that, call us and have 15% interest rates and 17, 18% interest rates on 6-figure loans. Like, you're just never going to get out from under that. So those are the two main options, and they both have their pros and cons, but I do specialize in the settlement aspect of dealing with those.
Yeah. Well, I mean, why don't we kind of just get into it? I guess, why and when would somebody want to look to settle a private student loan?
So a lot of people that reach out to us, they've tried a lot of different things. Their lender will offer some short-term options like forbearances, interest-only payments, extended payment plans, but they kind of find out that their balance doesn't really go down, or it even goes up over time, and they feel like they're throwing their money away. So they start looking for different options, and you come across three things: refinance, settlement, and then like scams. Which there are definitely some debt relief scams out there that people need to watch out for, for credit cards, for private student loans, for everything. But it's a lot of my clients are just sick of the loan. They want to be done with it. They're willing to go through a somewhat adversarial process, and there is some sacrifice involved. It does take some funding to pay off a settlement. Even if we're getting it less than 50%, that's still something the client has to pay and, stick to. And then the biggest thing I like to let people know about when we talk to people in our evaluation calls is that you have to be in default. The loans have to be so far behind that they are in default and become a loss for that lender. And that's the mechanism that opens up the possibility of settlement. Is the lender is able to write it off as a loss in their business taxes. They're able to use settlement to recoup some of the money. And that's the only time they have the incentive to actually go down to a good settlement percentage.
Is that what's called the strategic default?
Right, exactly. So for someone that's current, they're just maybe in the hamster wheel of making payments, double-digit interest rates in many cases, and just not seeing that balance go down. And it's kind of a drastic move, but that's when you intentionally miss payments from anywhere from 4 to 8 months with most lenders. And you will incur some credit damage during that process. So it's essentially a trade-off of what I would call short to medium-term credit damage in exchange for the savings on your current balance and also your total payoff, like you had mentioned earlier. And it really is a very personal decision. So for some people, if they need to get a house or a mortgage in the next couple of years, it's not the best fit. But generally, your credit will bounce back to a decent or even good range within 1 to 2 years after that settlement's paid off. So it really depends on where they're at in life, what their goals are, what their credit goals are as well. But one thing that kind of weighs against that too is my very high balance borrowers. They might have 150 to 200,000 in private loans or even more. Our largest client has 538,000 that he's co-signed on for multiple members of his family. When you have that large of a balance, you can have an 800 credit score and still not get approved for anything because your debt to income ratio is way underwater. So that's another aspect of, your numeric score is good, but this debt to income ratio is a real problem. Once you settle your loan, that becomes a zero balance. And that's a pretty powerful thing to, drop a large balance to zero. Then you rebuild your numeric score. Now you've got a good numeric score and a good debt to income ratio. And for someone looking to get a house, that's a lot more of a mortgage they can afford now with a much better DTI.
Yeah. No, I mean, I know it made a huge difference for me because I think you were talking about like 15%. I think mine were around 12 and a half, 13% by the time I was looking to settle.
Yep.
And I was paying, I think, almost $800 a month ish, and about 85-90% of that was interest too. It wasn't like, it was like $35 or $65 of it was actually going towards the principal and actually paying it down.
Right.
And it felt like such an endless, bottomless hole that was impossible to get out of. And then, I had talked to somebody before about looking at debt settlement with private student loan lenders. And then I was fortunate enough to find you. And I mean, you were like a godsend. You literally, saved me, like I said, around $100,000 probably over the long haul, and was able to knock that off. It did ding my credit score for a bit, but then you and I were just kind of looking at it just a little bit ago, and it's basically back into good territory. Once I, pay off a little bit more credit card debt, it'll be probably in really solid territory. And it's pretty incredible that this is out there. Like, why do you feel like more people don't know about this? I mean, it seems like it's such a hard thing to find. There aren't a lot of people like you who are doing this it seems like there's such a big need out there.
Yeah, there's really only a handful of us, I would say, that are legitimate private student loan negotiators. It's a $130 billion market. At the same time, it's overshadowed by the federal loan crisis as well, which is about 92% of the overall $1.7 trillion outstanding student loan balance. So like $130 billion industry is big by itself, but it's overshadowed by all the federal loan news, the clickbait articles about forgiveness. It's tough to find even a private student loan article. There was one recently by the New York Times. But the private loan borrowers just kind of get overlooked with all the federal loan issues going on. And the other, I guess, answer to your question is that traditional, what I call old school debt settlement it's a troubled industry. And that's where I got started back in 2009, pretty randomly. I had worked for the Palm Beach County Courthouse in Florida when I was going to grad school there. We all got laid off during the recession, the Great Recession. All the new hires got laid off. And I just started going into the office of a friend of mine who was a credit counselor and a negotiator. And I was just like checking out, like just trying to find work basically and find something else to do. I never thought I would like this kind of work. I kind of avoided math in college in a way. Like the political science degree is pretty light on math. I took algebra and that was it. So never thought I'd be doing, this is more consumer math, which I actually enjoy now. But the traditional old school debt settlement industry is, I was talking to somebody else the other day that they're dinosaurs. It's a lot of the same companies, the same people, the same model, which to me is by itself is very inefficient. They have a lot of lawsuits because they don't settle until you've saved up enough in your own account after making years of payments to them. And then on top of that, they charge anywhere from 1/4 to 1/3 of your entire debt balance. So if you're paying somebody 1/3 of your total balance and they're settling at 50%, then you've got interest and late fees. How much are you really saving on that?
Yeah.
So that industry, and I've done some consulting with some pretty high level debt settlement companies to actually see if there was a way to bridge the private student loan settlement process and get more of them to get involved. But the way they're set up, their model is just not a good fit for private student loan settlement for a couple of reasons. One, private student loan balances are on average larger than your average credit card balance. It's about $50,000 is the average private student loan balance. And the lenders are more aggressive. So you don't have time to save up for 2 or 3 years when you go into default. They're going to sue somebody before that. So the traditional old school model doesn't fit. Those companies don't even know how to identify private loans versus federal loans in many cases. So they just don't take that on. And it's people that I think a lot of us that do this, we started with federal loans, learned about private loans. I actually learned about private student loan settlement from an attorney back in 2013. And he's like, hey, those can be settled just like credit cards. And I was like, that's interesting, because I've done a lot of credit card settlement prior to that. And I settled my first private student loan with Sallie Mae back in 2013 and still did some federal loan counseling, was still doing some credit counseling and coaching, was kind of spread too thin. And then there was kind of just like a light bulb moment around 2015 or 2016 where I was like, this is really something. It's good because we have a smaller operation. It's kind of small batches of clients and I can work more closely with the clients. It's not a, kind of a mill that they're just running people through. It's a very personalized experience working with us, as I'm sure you know. And I really like that aspect of it as well. And that was the point where I just kind of drilled down into, just doing this and making this my niche.
Very cool. So when you were doing your first private student loan settlement, what was that experience like for you? Was that working with a client or was that your own personal thing? Because I know you've had on your own story on the homepage, you have a lot of your own like debt settlement stuff that you've done for your own life. Was that a client for yourself? Or how did you get into that situation?
Yeah, that was actually for a client. So I've settled some of my own credit card debts in the past, some medical bills. I have had private loans that I paid off before I knew about the settlement process. And I still have some federal loans hanging around too. But but yeah, that was for a client. And the funny thing is that the collector that I negotiated with at Sally Mae is still there today. And I talked
Oh,
to him a
wow.
couple months ago. So we build relationships over time in this industry. And that's been a major breakthrough for me, where it's not always a battle with people like it used to be.
Mm.
It's very much relationship based negotiation, because it's a smaller ecosystem than like the credit card industry, which I think is,
Mhm.
yeah, it's over $1 trillion now too. So,
Wow.
almost 10 times more than the private loan industry. But there's so many debt collectors there. Like, you have to really be working a lot of files to build relationships on the credit card settlement side. But it is a
Hmm.
smaller ecosystem on the private loan side. So I've built more relationships over time. And I really just applied the same playbook that I'd been using for credit card settlement, because the principles of debt settlement are the same. The strategies are the same, regardless of the type of loan being negotiated on, or the type of account. So it's really just kind of tailoring it to that specific lender, their own behaviors and policies. But I was a pretty seasoned negotiator by that point. I'd been negotiating for about 5 years. So it was just a bigger account than I was used to, and that's
Yeah.
also what got my attention, was that there are some large accounts here. And when you have a credit card client, you might have, like, my first client had 255,000 in credit cards, but it was over 15 cards. This was my first independent client in 2011. So it was 15 different negotiations, on a large
Wow.
balance. Whereas with one six-figure client now, it's one negotiation. So I'm able to take on more clients, settle more loans, settle a larger volume. And that's another aspect that I really like. But yeah, it definitely got my interest. And then I was able to kind of advertise, hey, I've done this for this client. And a lot of changes happened back then with the private loan industry. Navient formed in 2014. I started working with them. They split from Sally Mae, and the CEO of Sally Mae went over to Navient. So it was like, I describe it as like, a cell dividing into two cells, versus like an acquisition, or, a new company. So that's when I started working with Navient. And then there's been so many other lenders since then. A lot of bizarre stuff you don't see as much on the credit card side. Just, the student loan trust, buying and securitizing loans from other banks. It's gotten pretty messy. So navigating all those situations, and just all the knowledge I accumulated from that, kind of lends to, I guess, my negotiator persona, the knowledge base I can look back on, the confidence to deal with a difficult situation, because I've gone through so many already.
Mhm.
Um, but yeah, that's kind of where we're at today. I feel like I'm kind of at the top of my game, as far as my career, and getting through the pandemic when nobody cared about student loans, private or federal. Um, then we come back to kind of a raging crisis in the private loan industry with the Fed hikes, which caused all these variable private student loan rates to rise and just shoot through the roof. The high rates you were talking about. So um, it's a situation where everybody's looking for some kind of help, and nobody's happy with their private student loan situation for the most part, or they're maybe ignoring it and just making those monthly payments. But you looked into yours and saw that the majority of your payment went to interest. And once you learn that, it's like you kind of feel like you're getting ripped off, actually.
Yeah. Yeah. I mean, especially because when I was doing my own research, and I'd love to hear your take on this, when the peak of the private student loan crisis, or like the student loan crisis, really happened in the kind of like I think it's 2011 to like 2015. It was when a lot of
Yeah.
there was like no really regulation on it. Like the school prices were just kind of all going through the roof. It was just anybody could get a loan. And that was when I
Yep.
got my private student loans, was in that period, 2011, 2012, and
Okay.
2013.
Yeah.
And it was just like, wow, I was not prepared at all for that. I mean, I graduated with my BA. It was for, an advanced degree after that, but it cost me so much that it actually made pursuing work in that field nearly impossible for me, because I needed
Yeah.
to make money so that I could pay off these loans, and it
Right.
made my life a living hell in a lot of ways. And so, I
Yeah.
think it was always a big thing to try to figure out, how do I navigate this? What do I do with this? And for me, it was always, the federal stuff was fairly simple because of the like income-based repayment plans. Like, I could always keep those fairly low to where it felt fairly innocuous. But with the private stuff, it
Right.
was like there was nothing I could do to keep from really paying $800 a month, which was, almost everything at certain points in my life.
Yeah, and when you're just out of school and you're dealing with those big payments, it's like you call them and ask for some kind of help or to work with you, and the twisted thing is that they have no incentive to until you're farther behind or even in default.
Yeah.
And everybody feels like when they first take out these loans, they just didn't know what they were doing. But there's no way to anticipate, what kind of a monster that is on the back end when you're taking those loans out. And they'll have in the promissory note your expected loan interest and payoff. But when you took those out, the interest rates were a little higher probably back then, but I think they probably rose as the years went on. And also during that time, default rates were very high for private student loans. Just right after the recession, that was an all-time high, like I think 16%. So it was a very kind of a wild west for that market. One of the most troublesome lenders was collateralizing private loans back then, and they got into so much trouble, the National Collegiate Trust, for improper service for lawsuits and not being able to validate their debts. And that's when they were kind of in their heyday, was during that same time frame. And Sallie Mae was getting regulatory actions against them during that time frame, and then they split from, or they formed Navient to kind of rebrand a little bit and take the heat off. And then Navient now has a bad reputation as well. So it was definitely a very interesting time to take out a private loan or to deal with a private loan. I had a Chase private student loan from 2009, and it was very difficult to deal with also. And Chase has exited the private loan industry now completely, and a lot of the major banks have too, except one interesting trend is that they are buying and acquiring refinance companies. So they're buying student loan refinance companies, but they're not issuing their own private loans, like through KeyBank, through Bank of America, through Chase, Citibank. All the major banks are mostly out of that industry unless they've acquired a refinance lender, which is, I guess, kind of an interesting side note.
Yeah. Why is that you think that they're getting into the refinancing of the private student loans? Is that because people who are able to refinance are probably more likely to pay on those versus like the actual private loans ended up being too risky, or like what's the deal with that?
I think that's part of it. There's more of a vetting process, and there was a joke that refinance used to be just for doctors and lawyers, and that's not totally accurate, but debt to income ratio is the biggest reason why people get declined for refinance. But the other side of it is that those lenders can refinance federal loans into private loans. So they're able to tackle or tap into that other 92% of that $1.7 trillion market versus just this 130 billion private loan market. So they see the federal loans as a way to, tap into those and refinance those into a private loan, which is usually a terrible idea because you lose all the federal loan protections. I've talked to many people that would have qualified for maybe public service loan forgiveness, things like that refinanced to a private loan, which maybe made sense 3 or 4 years ago when the rates were like 2 and 3%. You're getting a good break on your 6 or 7% interest rate on your federal loan if you do that at that time. Now, the refinance rates are between 5 and 7%, which is about the same as what the federal rates are. So I got this email the other day, which I get a couple just from like credit card lenders that I have credit cards through, where they know that I've got student loans because they can check my credit report. And they'll send an email kind of saying, hey, you can get a lower payment, you can consolidate your loans into one, but they don't tell you you're going to lose all your federal loan options completely, which I think is a major issue in the industry. It's deception by omission, in my opinion, when they do that. But that is one of the major incentives, is that they can tap into the rest of the student loan market besides just private loans.
Yeah, I mean, that seems to be one of the biggest things with this industry as a whole. I would say specifically within the student loan marketplace, but anywhere in debt settlement, is there is a lot of like proneness to scams and people taking advantage of the situation or using words to market something like refinancing and saying you're going to have a smaller payment, but not also taking into account the larger picture or the other losses. Or, I mean, that's a huge win for the loan company because, hey, we get to have this debt for free that you have to pay back that you don't get these same protections on. I guess with a refinance, in that case, is that a situation where the borrower would at least be able to declare bankruptcy if they got that, or is it still kind of under that same student loan protection thing where you
Yeah,
can't really get
it's
bankruptcy?
right. That's a good question. It's still considered an education loan, so it's still
Wow.
exempt. It's a law from 2005 called the BAP CPA. There have been like some efforts to chip away at it a little bit, but for the most part, it's still very difficult. There's a lot of hoops to jump through. There's a very difficult process called an adversary proceeding to try to discharge student loan debt, whether it's private or federal. There
Mm-hmm.
are a little bit more technicalities on the private loan side. So ironically, if someone took out a loan and didn't use it for education expenses, they have a better chance of getting it discharged in bankruptcy than if somebody actually used it for their school. So if
Oh,
somebody
weird.
used it for vacations and buying a car, they might have a better chance of a discharge than if they actually used it for education.
And that
Um,
is not financial advice to anybody out
right.
there at all, but
Yeah.
that is
Um,
fascinating. Wow.
but that happens. It's like
Yeah.
there is that side of it too, where people do use the student loans for other things besides education, because
Yeah.
on the federal loan side, once your classes are paid for, you get the remainder of whatever you applied for as an overage check, which you're
Mm-hmm.
supposed to use for housing and basic needs and things
Right.
like that. There have been isolated reports of people using that for spring break and things like that.
Wow.
Not very isolated actually, but yeah, it happens, and it's something that I don't think the majority of people or the majority of student loan money is being spent that way, but some of it is, and it is important to acknowledge that. And that's part of the reason why we have such a large balance today overall for the total outstanding student loan amount. But
Mm-hmm.
then we also see tuition rising every year. If you look at the charts of when tuition and student loan balances started to rise, the tuition kind of tracks parallel to the rise in this overall student loan balance. So that's fueling it. And I have lived in a college town for quite a while, and we've seen, all these new dorm buildings go up, and they're like hotels, and the
Yeah.
dining halls are like, nice restaurants, and we've got a $5 million gym, and our football team's way better than they were 10 years ago because they poured a bunch of
Mm-hmm.
money into it. And we've got all these, administrators that are making six figures a year. So that has all caused the tuition costs to rise, and that's mostly fueled by federal student loan money. That's
Wow.
why they're able to do that. But we're based in Columbus and Athens, Ohio. I primarily reside in Athens, Ohio, and it's one of the poorest counties, if not maybe the poorest county in Ohio. And all the surrounding areas here are, rural Appalachia, very impoverished. But the city I live in, Athens, Ohio, it's growing quite a bit, and it's not fueled by, local businesses. It's fueled by federal loan money coming in, which then provides, the client base for local businesses, because our enrollments for the university, Ohio University, are increasing every year. So that's also a part of what I call the student loan industrial complex.
Hmm.
And it's a multifaceted problem that there's no quick solution to. I think it's going to be a multitude of things to try to tackle it. But I remember when it was 1.2 trillion back in 2013, 2014. That's when it started hitting the news. And I was kind of involved before that. So it was interesting to see, this suddenly became a newsworthy thing. And now it's, any forgiveness announcement or any new development is just clickbait on every media platform.
Yeah.
But it is a growing problem despite all the new programs, despite what, the current administration is doing. And I think it's just going to continue growing unless there's drastic changes.
Yeah, from your angle, because of what's happened in 2011, 2012, 2013, like when I was growing up, there wasn't a big concern about student loans, but that's much more in the zeitgeist, people not knowing if they are going to go to college anymore. Like a lot of people think of other options, where when I was growing up, that was
Yeah,
the only thought process now. And there's a lot more consideration.
right,
Like, do I want to do
right.
this, or do I not want to do this? From your vantage point, is for lack of a better word, the student loan crisis situation with new students, is that getting better or is that getting worse? Is it the same? Where do you think that is in our current country's state?
I think it's more or less the same or worse, because those tuition costs are just increasing so much. So people are forced to take out loans in many cases, even for like a state university. If you're in state, it's still pretty expensive where, the days where you could work part-time in the summer or work enough to pay your tuition, those are gone decades ago, So it's like, I think it's 70% of all recent grads have student loans of some sort. The average balance is, I think, 30 to 38,000, I think it is.
Wow.
So they're kind of stuck with having to do that because the tuition rates have increased so much. If you go out of state or you go to a private school, I mean, 50 grand, 80 grand a year is easy to do. And you'd have to literally work full time and go to class full time to pay that at best. What 18 or 19-year-old is going to make 70 grand a year, out of high school? Not very many. So unless you've got a lot of scholarships or some kind of tuition aid, it just doesn't add up. So a lot of people are forced to, and a lot of people are also forced to take out private loans when they've maxed out their federal loan maximum amounts they're allowed to withdraw or use that year. That's where private loans kind of bridge the gap in a lot of cases. And especially for like the private universities, the private colleges, I have a lot of clients that racked up pretty big balances just from those types of schools, and they may or may not be actually using their degree.
Yeah. For the audience's sake, what is the difference between a federal student loan and a private student loan?
That's a good question. So the federal loans are backed by the government, by the Department of Education. They have a lot more protections. They also have a lot more ability to collect if the loan goes into default. Like, we don't settle federal loans for a reason. It's kind of tough to negotiate with Uncle Sam. So they can collect indefinitely if it goes into default. There's no statutes of limitation, and they'll wait to garnish your Social Security when you retire if you wait that long on a defaulted federal loan.
Wow.
The pros of that, though, are that there's no credit checks really for most federal loans, except for some of the Parent Plus and graduate federal loans. So they're available to most people, and they're issued directly through the government, whereas the private loans are originated by banks or private lenders. It's pretty similar to like a line of credit from your bank, but it's not dischargeable in bankruptcy. That's the major difference. But it's very similar in all the other aspects to a normal line of credit. They're just going to give that to you in your bank account. They're not going to check and see if you spent that on, a Panama City spring break vacation or your classes and your books and everything.
Right. And if somebody already has loans and they're not sure which kind that they have, how would they be able to tell if, like, at this point, like, do I have a federal loan? Do I have a private loan? Is this something that I can settle or something that I can't? Is there a way to get out of this? What are my options? Like, if somebody's stuck in that kind of state, how do they figure out what their next step is, I guess?
Yeah, that's a pretty common thing for us to deal with kind of initially with anyone that reaches out. So studentaid.gov is the main website to apply for all federal loan options or payment plans, and also to see if your loans are federal or private. So if they show up there, they are federal. If they don't, there's a good chance they're private. And then we'll cross-reference a credit report after that. But that's the main website, is studentaid.gov. And there is some confusion around that, especially with Navient private loans, because they still have some federal loans as well, but they were through a different program that originated loans through banks backed by the government. And the wonderful reps at Navient will tell people sometimes that they're private when they're not. So especially for our Navient clients, that's a big thing we have them do initially, is check studentaid.gov and see if those loans are showing up there. And there's other options at that point if there are. But the federal loans can't really be settled for any major reduction because they're just not going to go very low. And once it defaults, they're going to add on a maybe 20% default fee. Then they'll offer to take that off as the settlement. So you're really just paying whatever your balance was before you defaulted if you try to settle a federal loan. So it's never a good idea to strategically default on a federal loan.
Got it. And if somebody has a federal loan and they are struggling, what is like your typical advice to them? Is it looking for one of the other payment plans or like forbearance? Like what are the common strategies that somebody can use if they are struggling with that type of loan?
Yeah, so forbearance is a good short-term strategy. It's, I would say, 3 months max at a time, because you're going to see your balance grow from that. Deferments may have an interest subsidy depending on the type of deferment, but those are mostly interchangeable and short-term solutions, which have their place, in the overall student loan repayment strategies. But you usually want to get onto a payment plan based on your income. And there's multiple plans like that. But the SAVE plan is the newest one. It's pretty popular. It has forgiveness after 20 years of payments. Income-based repayment is pretty similar. That's been around for a little bit longer. And then sometimes you have to do direct consolidation to consolidate your federal loans into one federal loan within the Department of Education to qualify for some of those plans. And you can do all that on studentaid.gov. But it is about as complex as I've ever seen the industry on the federal loan side. So it can make sense to work with an expert there as well. But it is all free to apply for on your own if you want to do the research and take the time.
Got it. And on the flip side, if somebody has a private student loan, like what are the options for them? I mean, it sounds like I know you can have forbearance, but I guess beyond that, like what else can they do, if anything?
Yeah, for private loan options, it's really just either what your lender is offering. So forbearance, interest-only payments, maybe a temporary interest rate reduction. They're not going to offer you any permanent solution. So the permanent solutions are refinancing for a lower interest rate or settling for less than the full balance. If you're one of those rare people that gets a bankruptcy discharge, that's great. But I think there was less than 1,000 bankruptcy discharges for overall student loans last year. We have 44 million student loan borrowers. So it's not available to most people. But again, they are making some headway with kind of chipping away at those laws. But until that law from 2005 is repealed or replaced, it's going to be very difficult to go through bankruptcy for a student loan. So for private loans, it really comes down to refinance or settlement. I did mention earlier the third option is probably a scam if you hear of something else besides those two. There is a debt validation scam that exists for both credit card debt and private student loans, where a company will say, hey, you pay us this much a month and we're going to send some legal letters and get your loans canceled. We'll try to make your lender prove that they can't provide the paperwork, and we'll get your loans canceled. They'll throw out like terms like the Fair Debt Collection Practices Act, the Fair Credit Reporting Act, these laws that are legitimate and exist, but don't have that kind of reach and power to send a couple letters and get a discharge. So every legitimate financial or student loan expert agrees that validation is not a repeatable strategy to get your loans forgiven or canceled. It might happen every once in a while, but lenders are very wise to that process. It's just a letter that you send to them, and people can do it on their own as well. But it's been so overused that lenders will actually respond aggressively and maybe even sue somebody right after they do that kind of request and they verify it. So that's something for people to watch out for is, if it sounds too good to be true, it probably is. If you can just send some letters and get something canceled, yeah, it's, probably not a good idea. And there are a few scams on the private loan side that are doing that. It's been going around in the credit card space for a long time. And they make it sound good. They make it sound believable. These are, salesmen that are just selling every day. They're not actually practitioners. They're not negotiators. They're not credit counselors. But for someone who doesn't know any better, for someone who doesn't know the thresholds of the Fair Debt Collection Practices Act and what you can actually do with that and what you can't do, it sounds appealing. And we do hear about people that fall for that. And then, 2 or 3 years in, they're like, where's my money going? My loans are still here. And nothing happens.
Got it. And for somebody who's looking at their situation and they're considering like, hey, I'm listening to Andrew, I'm hearing about this stuff. I would love to get out of my private student loan debt. And it sounds like you're able to settle. Like what is the experience that they can expect in working with you? And like, what kind of results can they expect through that process as well?
So it really depends on the lender. We are totally performance-based, so we only take on accounts we know we can settle. And that usually just is limited to for-profit private student loan lenders. So credit unions, state-based institutional loans, those types of private loans we're not usually going to take on because we know those lenders won't settle. So more than likely we've settled with that person's lender before. I may even have relationships at the collection department or with their collection agencies that they use. But it's a pretty smooth process for the most part. There is, an adversarial negotiation process where a negotiation might take longer than we thought, or you might run into, a more aggressive collector, have to kind of go over their heads and go to their manager or the director or something like that. But we try to make it as stress-free as possible for the clients, and just dealing with a loan on your own when you've never done that before is
Mm-hmm.
difficult and very stressful. And it's an emotional thing. So one of my
Yeah.
favorite quotes about debt is from a guy named Steve Rode, who said that debt is a math problem wrapped in emotions.
Hmm.
And all of my clients come to me in a different emotional state. Some are upset, some are angry, some are just like really happy to hear about the solution. But there's a lot of, elevated emotions with this process. And even for myself, when I've negotiated on my own debts in the past, I do this as a living, and there's still been debt collectors that have gotten under my skin or said something because it's personal. It's my own account. So we kind of take that aspect, off the shoulders of the client. We kind of go forward with that, that burden, so to speak. But it's different when it's, when someone is negotiating for you that's a professional, because it's not emotional for me. It's not personal. I want to get the best result for my client, but it's not my own debt. And that makes a difference. And then just the knowledge, the experience of working with all these lenders and having the different strategies, that plays a big role too. But I guess the biggest thing too is that unless we actually get a good settlement for somebody, they're not going to pay us anything. So it's a pretty ironclad procedure, and you're actually prohibited as a negotiator to take upfront payments of any kind before you reach an agreement. So that also is a good regulation for the industry, because it has a bad reputation for a reason, like debt relief in general. So I feel like there's a new wave of people that are doing this the right way with empathy and, the right strategies, a better, more efficient model to actually get the settlement done, to get your credit back into good shape soon, to get, the threat of lawsuits removed and things like that. So I feel like we are kind of the evolution of the debt settlement model at this point.
Got it. And if somebody is, let's say that, like in theory, their loan is in good standing, they're paying it, but they're just like, I just want to get out of this situation. Like, what are the steps that you're guiding somebody through into this process? Like with, I guess, do you teach them about strategic default? Like, what does that whole process look like?
Yeah, it's a process where you're going to have a lot of phone calls from your lender. You're going to get some maybe threatening letters, but they can't take any forcible collection action during that strategic default period. They might threaten it. That's their most favorite threat, but it's just not going to happen before they can actually file a lawsuit against you and win a lawsuit in court. So it's a lot of
And
phone calls and a lot of, yeah, go ahead.
yeah, just to clarify for the audience, like what is a strategic default and why would they choose to do that?
Right. So that is the process of making your loan become so far behind that it is now a loss for the lender on their books. And it's an official charge off is the actual term for a default. Once that takes place, it's usually 6 months for most lenders. Navient is 8 months. There's a few that do a 4-month charge off. Once that happens, it's an irreversible process. So you cannot reverse a charge off. You cannot reverse a private loan default. But it's the trade-off of missing payments, incurring some credit damage to get to the point where we can actually negotiate a major reduction on the loan.
And what are some of the risks in doing that?
The major risk is the credit damage. 93% of loans, of private student loans, are co-signed. So the co-signer has to be on board. And that's a big obstacle for a lot of our clients where, it's an older person or a more established person in life. That's what co-signers generally are. And they've got a good credit score. We have an emotional attachment to our credit scores in this country, which I think I look differently as, as a credit counselor, because I've seen my own score go up and down, and I've seen the difference, with different behaviors over time of kind of manipulating a credit score, so to speak.
Mm-hmm.
But the credit damage is the major risk. So someone has to be okay with that for both themselves and their co-signer. And a lot of the times the co-signers are just as sick of it as the borrower is. They know they're on the hook for something that they didn't even get any benefit from. So a lot of times they are ready to go through with that. And a lot of times they're my primary client. They're the ones that reached out. They're the ones that are looking for help. And, but yeah, I would say that is the major risk, but just knowing that it bounces back over time and that it becomes a zero balance for both parties. That's the trade-off. And again, it's very personal. So for some people, it's just not the right time. I've had people that I've talked to years ago that, needed to get a house or they were moving, and just even a apartment rental application, those will check your credit quite a bit these days. But once they're past that and they've got a few years of runway, as far as not needing a really good credit score, that's when it becomes a more feasible option. But that is by far the biggest risk. And for someone who's not okay with that, your only other option is really refinancing, because that does not significantly hurt your credit.
What are the benefits to once you've done the strategic default? Like, why does that open up the door?
It's mainly because it becomes a loss for the lender, and they now have to try to recoup that. So for them to go through a lawsuit and try to claw back a little bit at a time, even if they win through wage garnishment or the other common like forcible collection action after a lawsuit is won by the lender, is a property lien. And people are, one of the common questions we get is that people are scared of whether they're going to lose their house or whether that's possible. Even if somebody defaulted, didn't do anything, had a lawsuit against them, didn't defend it, still didn't settle, got a judgment, still didn't do anything, and the lender got a lien on their property, it's usually a passive lien where the lender gets paid if that property is ever sold, which is not ideal. That's not a good way to pay off a loan, by taking a chunk out of a sale of a property. But that's a common fear, and that's just, not something that's going to happen. So the lender knows they're not likely to recoup a lot of that statistically. They can call and make threats. They can do wage garnishment. They can try to levy a bank account, which means they can try to pull money out of a bank account. But if you know that that's a possibility, it's easier to defend against that. They have to know where you bank. But that is another risk of defaulting. But with those three collection methods, it's tough for them to recoup the full balance of the loan. I mean, the majority of those defaults are either going to be settled, or if they're small enough, they might just never even file a lawsuit, and they just take it as a loss and wait for it to go past the statutes of limitation for a lawsuit. So that's what makes a settlement much more appealing, is like, hey, we've got a lump sum amount. We're always coming in lower than what we intend to settle for. And there's a back and forth. There's, using hardship and budget information, kind of leaning on my relationships with that particular lender. But that's their incentive. Like, there's a point where a lawsuit is not worth it and a settlement is, if it's enough of a settlement. And the further behind a loan goes, usually the lower a settlement you're going to get. But for a lot of my clients that have a large private loan balance, they're not going to get far enough behind to settle for significantly lower 3 or 4 years into default, because the lender will sue before that. So generally speaking, they are going to recoup more money from settlements than forcible collection activity.
Got it. And so once a client has done this with their private student loan, if they've decided to go into default, the 3 or 4 months or 6 months or however long it is, like what is the typical kind of rate? And I know you mentioned it's kind of different with each of these different lenders. So but what's kind of like the average range that you're seeing these settlements kind of come into?
So we generally say between 40 and 60% of your balance. And by lender, we're getting Navient down to about 40 to 45%. Sallie Mae is a little more difficult these days because they sell to debt buyers once their accounts default, and the debt buyers all behave differently, but they all buy the loans at the same rate. So they all have the incentive to settle at some point. But we estimate about 50 to 60% for Sallie Mae. And then with the rest of them, it's usually in that range. And that's for a private loan through a for-profit lender.
Got it. And you said that there were four private lenders specifically that you work with. So what are the other two? Because you mentioned Navient, Sallie Mae. What are the other two that you tend to work with?
There's 4 major ones, I would say. Navient, Sallie Mae, the National Collegiate Trust, and Citizens Bank are the ones we see the most often. Discover does have private student loans, and they're kind of an anomaly in the industry that they will not go below 80% of the balance for a settlement, and they will go to a lawsuit fairly quickly. So the best bet for a Discover loan is to refinance it with a different lender. And then if you fall behind down the road, there's the chance to maybe settle that. But most lenders, and also they're one of the few major banks that's still in the private loan business, but they used to settle for much better percentages a long time ago, but they took a really hardball approach about 3 or 4 years ago. But yeah, I would say it's Navient and Sallie Mae, which by themselves are about half the private loan market, just right there, kind of a monopoly between those two companies. And then there's the refinance lenders, which are, considered private. So Earnest, SoFi, Common Bond, LendKey, Laurel Road. There's quite a few refinance lenders, and their willingness to settle definitely varies. Earnest is a refinance lender that's owned by Navient, so they will settle for the same rates as Navient usually. But yeah, the majority of the accounts we hear from are usually Navient or Sallie Mae, with some SoFi's, some Citizens Bank, and National Collegiate Trust sprinkled in, I would say.
Got it. And then for someone who is considering like either this or they're looking at a refinance, like when would be a situation that you would encourage somebody to go into refinance versus looking for kind of the settlement route?
Yeah, so we go over both options on our settlement evaluation calls, but it's usually if someone has a co-signer who's just like, no way, are we going to miss any payments?
Mm-hmm.
That's the big one. Or if they don't have funds to settle and they're still current, that's another way that, or another route they can take. But if you missed a few payments, refinance is usually not an option anymore because you have a few late payments, you're just not going to get that approval. So it is tough to get approved for refinance unless you have a good credit score, good income, good debt to income ratio. So your income is at least half, your annual income is at least half of your total debt amount or more. And the co-signer's situation also factors into it. But it's mostly people that don't want to deal with a credit hit and don't want to make that sacrifice to save a lot of money and are okay just paying, a 6% interest rate versus a 14% interest rate, which is, a big improvement. But
Yeah.
in normal times, a 6 or 7% fixed interest rate is not a great interest rate. And that's about where the refinance rates are right now. But for someone that's got, 15 or 17 or 18%, it's a big difference. Their payments will go down. They're going to see more of their payment applied to the loan. So it is a good solution. But the con of that, the downside is that you're still paying the full balance plus interest, just a little less interest.
Right. Yeah, I know a lot of the situation that I found myself in was because I had built up credit card debt and then went through a similar process with Freedom Debt Relief and ended up, paying
Yeah.
off a lot of my debt through them.
Mm-hmm.
I had a low credit score and it was like impossible for me to refinance. And so I felt kind of stuck between a rock and a hard place with the student loan situation. Cause it was like, I can't refinance. I can't do this. I can't do that. But these things are
Right.
also, sucking the life out of me. And, that's where, again, I found you and you were such a bright spot that I was lucky to find and really saved me, a ton of money. So thank you again for all that you do. I
Yeah,
really, really
absolutely.
appreciate it. Yeah.
Yeah.
How did,
And your experiences, I would say like you were a great client. You followed all the instructions. You communicated very well. You did your part too. So that plays a big role too.
yeah. Yeah. Well, I mean, you really did make it easy. I mean, it's very simple. Like once I talked to you, once we kind of figured out, yep, this is the route. This is what we have. This is what the process looks like. It became very, very simple. And you were really, really communicative with, each of the steps that need to happen or as things were going along, how the negotiations were
Mm-hmm.
going. It was very clear. And it was definitely probably one of the best like Thanksgiving messages that I've ever gotten. I'm just being like, hey, looks like we're gonna
Yeah.
get this this amount of a settlement. And it's just like, wow, this is really happening. And to have that $65,000 off of my plate has been such a gift. I have an extra whatever it is $800 a month that goes into my bank
Right.
account now for other things that
Yep. Yep.
is a huge, huge benefit to me. So I can't encourage anybody enough if you have private student loans or or you're looking for some sort of counseling at all to reach out to Andrew. He's such a valuable resource. I guess Andrew, something I would love to pivot into, I guess, from here is we've talked a lot about the student loans, and the industry, and the process with settlement. But I'm curious about like your own story and like beyond, I guess, just kind of the fascination with it from you as a person and as an employer, but like from your own personal standpoint with debt or finances or any of these things, like why is this so important to you to do this kind of work?
That's a good question. And when everything dried up during the pandemic, when half my clients canceled within the first half of 2020, and I stopped getting new clients and the revenue stopped coming in, that was a question I was asking myself quite a bit. Like, why am I doing this? I really had to find that reason to keep doing it or to keep trying to do it, because it wasn't financial at that point. And obviously, this is how I make a living. This is my full-time job. But it's it's something I'd consider my contextual purpose. Like it's not maybe the reason I was put on this earth to deal with this specific type of student loans, but
Mm-hmm.
it's my contextual purpose right now in life with my career. And, reading through our reviews and hearing from grateful clients, it's like I really am making a major difference in people's lives, and it's purposeful. It makes me feel like I have a sense of purpose with my career. And I enjoy negotiating. I've always liked that. Like that's why I'm not doing federal loan counseling anymore, because it's all paperwork and applications. And it's interesting in its own way to try to solve that puzzle. What's the best payment plan? What's the best combination? But I like the kind of the battle. I like the adversarial nature of the negotiations and having to kind of win a fight, or at least get a truce on favorable terms. Um, but yeah, I've had a lot of great clients that have just kind of showed me that I am making a major difference for them. And I've heard the stories afterwards. And I had one client who, they were like negative 400,000 in
Wow.
debt basically. And their private loans were like 160,000. And I talked to them like a year or two ago, and I'd settled with them for them 5 or 6 years before that. And they like had $1 million net worth by that point. And
Wow.
he said I played a role in that, which was, really kind of powerful to hear. And then we have people that have all kinds of just, different hardships. Nobody really intends to get in trouble on their private loans. One common refrain that I hear is like, I pay all my other stuff, like I'm just falling behind on this. And it's like, yeah, people should pay their bills for sure. But banks and lenders should also offer reasonable terms and not, like some of these interest rates are borderline usury.
Yeah.
So that's the other side of it, where it's kind of like a Robin Hood thing. We're fighting against these huge companies, and we're just a small operation in Ohio with 2 other employees, and we're going toe to toe with these huge million or $1 billion companies in some cases, and it still feels really good to get a settlement letter. Like I was kind of known
Mm-hmm.
at my first office I worked at in 2009, where when I got a good settlement, I'd kind of pound on my desk or like yell or something. And I still do that to this day. Like it
Yeah.
still just feels like it's just exciting. There's just, no other feeling like that for me in my career.
Yeah.
So that's why I'm still doing it. And it's also like I've been doing it for so long that there is like, what else am I going to do? But I would still shift away from this if I didn't like it, or it wasn't working, or we weren't getting good results. But I'm pretty invested in just doing this for a while. I eventually want to
Mm-hmm.
teach people how to settle their own debts. And I feel like that information is kind of being gate kept in the industry. And if people had that knowledge and like a way to apply that systematically, and the way to kind of adopt the negotiator psychology, I think that might be our next move as a business, is kind of opening the door to that knowledge that's being withheld right now by
Yeah.
all the companies that do this.
Yeah. If somebody was wanting to, I don't know, negotiate their own loan, like what would be your like top 3 things that you'd say to them to start off?
Yeah, that's a good question too. So there are some common mistakes that we'll hear about when people reach out to us and they've tried to work on their own stuff. The first, probably most common mistake is, it sounds kind of simple, but just offering the amount that you want to settle for as your opening offer.
Mm.
So if somebody wants to settle a $10,000 loan for 5,000, they offer 5,000. Then there's no room to go back and forth. The lender knows that, okay, we can play the game with them a little bit, or the collector. And you're going up against people that, do this full time every day for decades. Like the debt collectors I work with, they know they can't really get one over on me, but I've heard them talk to other people. And there's one lady at a major lender that I know pretty well. She has the sweetest voice. Like you'd think she's the nicest person in the world when you talk to her. I enjoy talking to her, negotiating with her. And she's very polite, very cordial. And somebody called me up once and said, yeah, I just talked to this person. They were trying to do it on their own, and they threatened to take my house. I was like, is this the same person? And it was. So it's
Wow.
like, they just have that switch they'll flip when they're talking to borrowers. They know that there's a knowledge gap, and they're going to try to take advantage of that.
Hmm.
So obviously I'm not going to give away the whole playbook until we actually develop a course or a way to, systematize that knowledge. But in
Yeah.
general, offering the amount you want to settle for is a major mistake. You want to always offer a lower amount, but not so low that it's insulting to the debt collector either. If you offer them 5% of your balance and you've got a fresh default, they're just going to laugh at you, and they're going to take it as bad faith negotiating. So it
Mm.
needs to be low enough that you've got some room to go back and forth. Ideally, you know about that lender's settlement trends before you even go into the negotiation. That's a missing piece for a lot of people. That's kind of hard to find. I mean, you go on Reddit, you're going to get a bunch of one-off anecdotal stories that you can't really draw conclusions from because there's no trends. It's just people that have said, oh, I got this or I got this. Well, how long was that account in default? What were your circumstances? What was your hardship? The data is not really there to have that range of what your possibilities are to kind of ballpark what your opening offer should be. But in general, that's mistake number one. Negotiating in like fixed or even dollar amounts, like 5,000, 2,500. If I wanted to offer 2,500 as an opening offer and I expect to settle for more than that, my offer is going to be $2,378 that we borrowed from my client's neighbor's aunt. A very specific real life number that could be in somebody's bank account versus an open, negotiable number like 2,500, 5,000, 10,000. That just lets the collector know you're playing the game. And then the same thing with percentages. You don't want to negotiate in percentages. They might, but when I hear that, I'm like, oh, I didn't even know what percentage this was. And obviously I'm ballparking all of that before we negotiate with our clients. So we'll talk to clients in terms of percentages, but we'll never negotiate in percentages because again, it sounds like you're playing the game. It's not a fixed amount and they're going to counter you every time with that.
Got it. Do you have any sense of like why things? 'Cause I've heard of that before, and I've seen it myself with the very specific number. Like,
Mm-hmm.
why do you get a sense of that seems to have a greater effect versus saying 2,500 versus saying 2,350, 268?
Yeah, I just think it just sounds like a number somebody's throwing out.
Hmm.
So the collector's like, yeah, we're going to counter that because they don't have an even 2,500 in their bank account.
Right.
It's going to be something else than that.
Okay.
I think that's the main reason why.
Got it. Very cool. Well, and I appreciate that because I think that's such a valuable piece. You also mentioned a lot of these kind of scare tactics that a lot of uh, the lenders or the collectors will use. And even when we were going through our process, you were like, hey, they're going to send you this letter. I've seen this before.
Right.
Don't freak out about this. This is what's going to happen. Like, what are some of the common scare tactics that they might use to persuade you to either pay a higher amount or try to pay the whole thing or freak out or back out of a situation? Like, what are the common things that people should be aware of that are most likely a scare tactic or a bluff versus something that they're actually going to follow through on?
So I would say the threat of litigation and also false urgency deadlines are the main two. So the threat of litigation is their most common and favorite collection threat because it scares people. And to take that tactic even further, once accounts go into default, there are law firms that are licensed to collect in all 50 states, but maybe only practice law in a handful of states. So there's one called Weltman, Weinberg, and Reese based here in Ohio. They're licensed in the surrounding Midwestern states, and they collect all over the country. But if somebody gets a letter from a lawyer in Nevada from Weltman, Weinberg, and Reese that's based in Ohio, they don't know that they can't sue in Nevada. Like they just got a letter from a law firm and they're terrified, like that's going to make them pay up or call in a weakened negotiating position because they're already afraid, So that is a common thread through, like after a few missed payments all the way to post default is the threat of litigation. So it's their favorite threat. It's one of the least likely things to happen if you're proactive. The other thing is a sense of false urgency. So all debt collectors and even the pre-default collectors that are trying to just get you back on track and get a payment, they have very strict month-to-month quotas, month-to-month deadlines for themselves, for their own collection capabilities. So they're going to talk very much in terms of this month or even before that, a shorter sense of urgency. We need a payment in 3 days. And it's like June 5th or something. They need a payment by the 8th or we're going to do this. Nothing happens until the end of the month. So we hear about that quite often, where I had a client who reached out to me after this, but a debt collector was trying to get her to make a payment before the holiday weekend for Memorial Day. And I was like, that was like the third week of the month. There's nothing that happens in the third week of the month. It's always at the end of the month. So even then, there's a good chance it's going to still stay in that department into the next month. But that debt collector couldn't care if it was 2 days into the next month or 10 years from now. It's the same to them. They want something by the end of that month, and they're very focused on that. So the end of the month deadline can be a real thing. With our larger balance clients, if they go into default, we try to settle within the first month. We actually do that for most of our clients because you never know what's going to happen the next month. And I try to eliminate that sense of uncertainty of a law firm assignment, a debt collector assignment. We're still going to settle, but it's just more complicated. It's, a little harder if it goes to a law firm. But you never really know what's going to happen the next month, especially in a larger balance. But if you've got $15,000 with Navient and they're in default, you're in default for 2 months, and they say you've got to do something by the end of this month or it's going to a law firm, it's probably going to be in their same recovery department the very next month, and maybe 6 to 12 months before they do anything. So the larger the balance, the greater the risk of litigation, and the more there is a real sense of urgency to do something. But it's also important to recognize when a debt collector is creating pressure with a false sense of urgency.
Do you have a way, either personally or that you recommend for people, to be able to navigate which of those it is, whether this is like an actual threat or an actual deadline versus the sort of perceived sense of urgency?
Even for us, it's tough to know for sure. So if it's in the middle of the month or it's not at the end of the month, I know for sure it's a false sense of urgency because we have until the end of the month until anything could happen. But they're not going to tell us if they are planning on doing something that next month. And we had a client with $244,000 with Navient back in December. And he reached out to me about 3 months after his account defaulted, and they were about to send his account to a law firm. And I took them at their word on that one. Like, they're going to focus on the bigger accounts. We've seen larger accounts go into a law firm assignment after the first month in default and even immediately after default. So it is possible, but it's not as common. I mean, most lenders are not going to send your account directly to a law firm. Like, it happens, but it's rare. So I've got, 30 something active clients right now, and they're in various stages of strategic default. We're already in default in negotiations. And we've had one that was sent out to a law firm, and we got it pulled back through our relationships with Navient. So that's another thing I can do that someone, on their own can't really do, because Navient knows I'm going to negotiate with them every month. I'm always going to be able to settle if they come down low enough. So we can do things like that and have a director pull back an account from a law firm assignment and work on it within a non-legal department in a way that, the average person can't do. But even for us, it's tough to really know for sure. So we just take an approach of eliminating risk and uncertainty and trying to settle as soon as it goes into default. If they're already in default, you can look at whether your debt collector is a legal or a non-legal entity. So if they send it to a law firm, pretty good chance, unless it's a law firm that's not licensed in your state, which is a tactic, that I mentioned earlier. But if it goes to a law firm that's licensed in your state, they are going to sue within a few months, probably. You can generally assume that. There's still time to negotiate. You're not going to get quite as good of a settlement. You can still get something decent in most cases. And even when they sue, there's still ways to defend that and still settle. But if you see a law firm assignment and they're in your state or in a state near you and they're licensed in your state, assume that they are serious about taking legal action.
That's great advice. What's the largest student loan settlement that you've had?
$317,000 so far.
Wow.
That was with Navient. And again, we just signed on a guy that has $538,000, but his is an unusual situation because he's the co-signer for multiple family members. So that will be our next. Well, that'll be our biggest one when that happens. But up until now, it was 317. I think the 244 3 months ago was the second biggest. We've had we had one that was 260. So we've had a handful over 200,000, a ton over 100,000, and under 200. But 317,000 settled for 103,000
Wow. So they saved him
Um,
almost over $200,000 almost.
yeah, that was like a
Yeah.
31 or 32% settlement. That was back in 2019, I think. So
Wow.
Navient's tightened up a little bit since then. But the larger your balance, like if you have a lump sum to offer, that's going to really, like, they're not going to ignore that, you know? So the
Hmm.
larger the balance, the greater the chance of getting a lower lump sum settlement. And we've gotten a few still in the mid 30% range with Navient. For Sally Mae, it's a very different calculation. It depends on who the debt buyer is. There are some very aggressive debt buyers that buy these loans for 15 cents on the dollar, which I don't always tell people because it's just painful to hear that, you know.
Yeah.
That's the business, and I learned that by getting a bill of sale from an attorney at one of the debt buyer companies who didn't need to provide me that, but I kind of don't want to say tricked him into it, but I told him it was needed for validation of the account, and he actually didn't need to send it for validation to meet that threshold. It could have just been the master promissory note, but he did send me that, and they buy these accounts for 15 cents on the dollar, and then for them to still settle at 40 or 50%, you know, they're still making a profit. So we did get a 45% on a $190,000 account with Sally Mae 2 months ago, but our larger balances are generally with Navient, and the refinance companies too will have, you know, larger balances as well.
Hmm.
They are, you know, usually consolidating or refinancing a number of loans, so those balances are usually higher.
Okay. If if these debt buyers are buying them at like 15 cents on the dollar, which is even less than the settlements that we're typically getting, why can't we, or why doesn't the if it's Sally Mae, for example, if Sally Mae is doing that, why not just sell it at 20% to the client directly, or 25%, and like make a little bit more money on it versus going through the debt buyer and then coming back to us at like this other higher amount? Like, it just seems, why have
Yeah.
this other middleman in the process?
So it's a volume game for them. So they're not going to settle every single account. The debt buyers
Hmm.
are not going to. So if they settle enough accounts, they get some people on payment plans. They get some people that don't pay anything and they have to sue them. It's a range. And the bill of sale that I got from this particular attorney for the debt buyer, it was like a $4 million portfolio. My client's account was in that. So they're buying
Hmm.
large batches, and it's a grimy business. But man, if I didn't have any ethics and morals, I would definitely look at getting into it, because it seems like they're getting pretty good margins on that. But they're not settling every loan at 50%. So
Hmm.
I think overall it works out where they have a profit margin, but it's still not in the incentive for the lender to settle at 20%.
Hmm. Do you think that there's any way to, I'm going to say, like, subvert that part of the market? Like, is there a way for, if there was somebody who had enough money, who was like, oh, I don't like the way the student loan industry, and they have a high moral standard. They're like, hey, I'm going to come in as a debt buyer, come in and like do this and provide like an available payment plan. Because I know one of the issues with, even the settlement thing can be like, hey, do you have a lump sum or not? Because that can vastly, affect the settlement that you're going to get. And
Mm-hmm.
just come in and be like, hey, I'm going to buy these things 15 cents on the dollar, make a little bit of money off the top and sell it at 20, 25% in a payment plan to the person over time. Like,
Yeah.
why hasn't anybody done that yet? Because it seems like such an obvious, I don't know, solution that could be a huge win for you if you're a high ethic person and still want to make a decent amount of money.
Right. So this $4 million portfolio is bought for like 5 or 600,000,
Wow.
I think, or maybe less than that. Whatever 15% of 4 million is. So it is possible, but there are a lot of regulations in the debt buying industry. So you'd have to create a debt buyer company, get licensed, go through all that, certification and licensure. But it would be possible for someone to do that, or a company to do that. There is the debt collective, I think they're called, that does buy up loans or pay off loans in a certain way. They're a nonprofit, and they're doing some great things, but they're just scratching the surface of the overall issue. But it is possible for someone to form a debt buying company, go through all the the regulatory processes and certifications, and then try to get a contract with Sally Mae or another lender. There is a brand new debt buyer that we've been dealing with since last year. that was formed by other veterans of the student loan industry, so to speak, on the lender side. They're very difficult to deal with. So they've taken the opposite approach. They're like, how can we be more aggressive? how can we put people through more crap than they're already going through? So it is possible to form a new company and do that, but it would take some capital, and you'd still have to function as a debt collector in some aspect to make anything back on your portfolio, unless you were a nonprofit.
Yeah, I want to say, is there anybody who's in the nonprofit space that's doing that or looking at doing that?
I think just the debt collective, and I'm not sure if they're specifically buying private loan portfolios, or I think they're also paying off federal loans, which is just a direct payoff because those are never bought or sold.
Right.
So that's another kind of a side note on the federal loan side of things. People think that their loans are getting bought and sold because they transfer to different servicers, but they're just transferring servicers. And it's something I try to inform people about, because if you feel like your loan's been getting bought and sold 10 times, you feel like you're getting ripped off too. You feel like you're getting the short end of the stick. But on the federal loan side, there's never a sale. The Department of Education does not sell any of their loans. It's just a transfer to a different servicer. On the private loan side, it's not as common. Sallie Mae is the main lender that is buying debts post-default. The National Collegiate Trust was securitizing and buying portfolios before they were in default. They got into a lot of trouble and are not doing that quite as much anymore. But overall, most private loan lenders do not sell their debts. SoFi actually is a refinance lender that sells their debts post-default. We just settled with them last month at 40% as well. And you kind of mentioned earlier, the difficulty of coming up with a lump sum settlement, but most lenders will agree to a structured settlement over time, whether that's 2 years or 4 years or 5 years, with a down payment. So you still have to have some funds. If it's a larger account, and we settle at 40%, but it's 130,000, your down payment's still going to be a good chunk of money, but you're still settling over 4 or 5 years or 3 years versus having to come up with that all at once. So it's a much more flexible way to still get a good settlement, not quite as low as a lump sum, but still a good outcome.
Yeah. If somebody's like looking at whether they're a good candidate for this, I mean, obviously they can talk with you and go through that process, but they're just kind of looking at their own finances. They're being like, hey, I need to make sure I save up a lump sum before I can go into this for down payment. Like, what is the percentage range of the down payment usually need to be to kind of qualify for that process?
Yeah. So a healthy down payment is a third of the settlement amount, where your settlements are typically 45 to 60% on the structured side. So whatever your balance is, ballpark it in there. And then a third of that amount is a good, healthy down payment to incentivize the lender to settle, for one thing, and also to keep your monthly payments lower on the settlement. The lowest that some lenders will go is 10% of your defaulted balance. But unless you have a long enough term, you're going to end up paying more of a monthly payment because there's less of a down payment. So we usually estimate for 33%, 1/3 of the balance of the settlement balance, and then kind of go down from there if we need to.
Got it. Okay, cool. So if somebody's looking to settle, then they want to look at basically, let's say, call it 2/3 of their current balance, and then 1/3 of that portion of it.
Yeah, or even less. I'd say maybe half their current balance, 60% of their current balance, and a third of that amount.
Okay, got it. Cool.
The majority of our clients are Navient or Sallie Mae, like we were kind of talking about. That's kind of the breakdown in the industry of, those two companies having almost half the market share of all private student loans. So we see that representation with our clients too. And we've got 6 clients with Navient this month. And it's almost a straight numbers approach, because there's kind of that cumulative effect of the whole amount that I'm offering or the whole amount that I'm working on. And I even told the manager there, who I know pretty well, I was like, hey, we got $630,000 of accounts with you guys this month. And just kind of putting it out there, which that's one of my bigger months. I think the biggest one I had ever was 732,000 in one month.
Wow.
That was also the same month we had our biggest one ever, that $317,000 client. But this is a more even distribution, and one of my goals is to hit like 1 million in accounts in 1 month in negotiations.
Wow, that's awesome. Yeah.
So we're just getting everybody ready, and we kind of feel out the negotiation process early on. I kind of even let the collectors and the lenders maybe get a little desperate, like they're going to call me a lot, and I
Mhm.
don't do a lot of heavy negotiating at first. I kind of ramp up over time and let them be ready to, to talk to me. Like they're just so happy when I call in. And then it's just kind of doing the dance. There's a very specific strategy that I have for Navient, and there's like certain times where I'll use the hardship and the budget form, which I think we did for you too. There's a certain
Mhm.
point in the process where I kind of deploy that. And then we use that end of the month collection pressure to really wear them down and maybe kind of hardball on one of our counter offers and then just wait for a week. And then sometimes
Mhm.
there's a breakthrough like towards the end of the month because they have that quota to meet. So we're also operating on that monthly time frame, and we know that we can kind of use that to our advantage, which is nice. But then there's other
Mhm.
lenders that we know it's going to be just a battle for months. And a long-term negotiation looks very different than like a Navient negotiation. So
Mhm.
Citizens Bank, for example, does refinances of student loans. They're well known to take a year of negotiations to get down to a good settlement percentage.
Wow.
Yeah. So we kind of let the clients know ahead of time. There's a couple other lenders that are like that too. And that's a different strategy where we're kind of wearing them down over time. By the fourth or fifth month of negotiations, I might not even talk to them for a month. It's like, we might just kind of freeze them out for a month or two and then go back to it. And then sooner or later, they all seem to eventually come to the table. Maybe it takes the account being in default for over a year, and that kind of flips a switch on their side of some sort, or it gets assigned to a third party debt collector, and they have more leeway to negotiate. So that is definitely an aspect of negotiating some of these, especially with the tougher lenders, is just waiting them out for a long period of time. But I'd say the average settlement is between 1 to 6 months of negotiations, and most are probably 1 to 3.
Wow. When you're negotiating with some of these different banks, because I know that you have, or I guess lenders, I know that you have relationships with different ones. Do
Mm-hmm.
you does that change the length of the time of the negotiations? Say if you have, it sounds like maybe Citizen is like newer, for example. If you have if you develop a relationship over time, would you expect that to be a place where it's like, oh yeah, now that we've been working, they know who I am, we have a relationship with
Yeah,
them, we probably start getting this done in a month because they know I'm gonna get to this number anyway. So we're neither one of us want to waste our
right.
time. We're willing to kind of get to where we need to go as quickly as possible and move on.
Yeah, it can definitely help a lot. It can also avoid some of the back and forth kind of battling that you have to do sometimes. It's like once you've kind of proven your mettle and like fought with them a couple times, if it's a newer debt collector or a newer lender, they kind of respect that, and it does like you
Mhm.
build relationships during that process. So if I don't have relationships there at the time, I'm working to build those in that negotiation and work my way up the ladder. But if we already have them there, it does help quite a bit. And that's something that I think we talked about earlier, that people doing this on their own, that's an element you're just never going to have. Even if I coach somebody and tell
Mhm.
them exactly what to do, the right mindset to have, the right psychology, the mistakes to avoid, the whole playbook, they're not going to have those connections, and they don't have the ability to build those relationships, because what really helps incentivize those kind of higher ups in those different organizations is that they know they'll be working with me again. It's not a one-off settlement, but it can still help an individual who's doing it on their own to try to talk to a manager or supervisor. A lot of times they might try to play the same game, and there's always kind of the joke of like, let me get my manager, and it's like the guy next to them in the call center.
Right.
um, you never know for
Or they
sure,
come
but
come back in a different voice.
right, right. But yeah, we had one last month, and it was assigned to a collection agency. It was a SoFi refinance loan bought by a debt buyer, assigned to a collection agency that I've had lunch with one of their vice presidents before. Like I know them really
Mhm.
well. They're based in Ohio. And I know the director of operations, and his wife is one of their senior collectors. So I was like, hey, this person's name, what do you think we can do here? And she's like, I think we can get to 50%. It's like, okay, and like, again, we don't normally talk in terms of percentages when negotiating. This would be one
Mhm.
of those exceptions where it's like, we're kind of skipping past the games, and it's like, let's just do a deal, and that
Right.
does happen sometimes after you've been doing this for long enough. And I was like, okay, I know we can get below 50% with this lender. Like I know they'll go to 40.
Yeah, so
So
there's
I
still a
come
little
in
bit of
right.
game. Yeah.
Yeah, yeah. So I come in right below 40%. It's an off number. it's like 37.85 whatever percent. It's not an exact, even dollar amount. And I come back with that. And she's like, "No, we can't do that, but we can do 40." I was like, "Okay, just send me the letter." Like, we know that's the best case scenario. And it's also a matter of knowing when to keep pushing and knowing when you've got the best deal. And we just know from past experience that with this particular lender and their debt buyers, 40% for a lump sum is our best case scenario. But it's kind of like, like a mechanic changing changing somebody's oil. They've done it 5,000 times. They're going to do it. It's going to be really easy for them to do that, quickly. They're going to do it without any issues. If I try to change my own oil, I'm probably going to mess something up, to be honest. I'm not a car guy. So trying that for myself on the first time, good chance I'll mess it up. But someone that's done it so often, it's like, exactly what to do and when. And there are some negotiations like that. And it's nice as a negotiator to have those. It kind of balances out the hardcore battles that we have when there's one like that.
Yeah. I was curious about that when you were talking about, relationships and negotiations. And one of the things you mentioned was, when you're talking with this person, there's a lot less game. It sounds like there's still a little bit of game that kind of goes in, because you probably could know that right off the bat you want to go to 40 or whatever it is.
Yeah.
Right. But I'm curious, when you are negotiating with a brand new person, how do you gauge that line personally of how much further can I push this? Like, how much tension do they really have? What are they going to actually do, and how do they respond? Like, what are some of the cues maybe you're looking for when you're in the conversation, or what does it actually look like?
Yeah. Good question. And that's still something that we see, every once in a while. There's not a ton of situations where we have not had any experience with that lender or that debt collector, but there still are some. There's, obscure, smaller loans, or, some lender that we'll see just every couple of years that's, just not in the picture very often. So it's a lot more of a situation where I'm feeling it out quite a bit more. I'm kind of seeing, like, there's so many signs you can get from a lender once the account defaults as far as their willingness to negotiate. So that includes what type of collection agency do they assign it to? Is it a law firm? Is it a third-party collection agency? Is it their own internal collection process? How long do they keep it there? Like, their level of perceived aggression is related to their willingness to settle. If they send it to a law firm right away, then that's a kind of an aggressive move. You don't see that too often, but we see it every once in a while. One of the Sally Mae debt buyers is doing that, and they're sending it to that law firm I talked about that is only licensed in a handful of states in the Midwest, but can collect non-legally in every state. So big time bully move. People get that letterhead with the attorney's name on it, and they're like, "Oh crap, I better call them up and pay something." But it's a lot more of just feeling out what the other person is coming back with. I'm not going to usually come in with a hard offer right away and have a little conversation with them, kind of maybe name drop, I don't know, the lender we're working on, like that type of account, or just mention, I've been doing this for over 10 years. And, oh, you guys are in Columbus. Oh, I know this such and such debt collection agency there, blah, blah, blah.
Right.
So kind of establishing a little rapport, seeing how open they are to working with me, and then, maybe looking at going up the ladder to a supervisor or a manager. But as far as like the behavior goes, if we're in a negotiation, and sometimes I like to let them throw out the first offer just to see what they're going to say. And then they're like, "Well, we can do 80% on this." And even if they negotiate in terms of percentages, I never do. And people should never do that, even if the other party is saying that. But 80% means they're willing to play ball. That means I can probably get to 50 or 60% with a little more time and effort. If they say, we're not going to settle at all, that could be a lender that just isn't going to settle, which some of them don't. If it's an institutional loan, like directly through a school, we had to cancel an appointment today because somebody had a loan directly from MIT. And I was like, they're technically private, but the real term for those is an institutional loan from the institution. And they can withhold transcripts. They're kind of the worst of both worlds between federal and private. There's also state-based agencies that have institutional loans that people think are a normal private loan, and it's not. But you start negotiating with those kind of places, which I've done many times before, at least attempted to. They just come back and say, "Hey, we're not going to settle." And I had one negotiation about 8 years ago with a credit union. Small to mid-sized credit unions are notorious for not taking a penny off, and these guys for a year and a half did not take off a penny off the balance. So we kind of knew that going in, and the client was like, "Well, let's just try it." And it's like, okay, like I had the time to do that, which I don't really do as much anymore. If we know it's the type of lender that's probably not going to settle, we don't take it on because we're totally performance based. But those initial reads on the conversation and what the lender's coming back with, where they assign the account to, and how aggressive they are. Like sometimes the accounts default and you don't hear from anybody for months. It's like, well, this isn't a big priority to them. So that also means they're likely to settle because they're not being that aggressive off the bat.
Yeah, I've heard sometimes, and again, this is not financial advice for anybody, but I read I think online on Reddit, certain people that had defaulted on their private or federal student loan even, and
Mm-hmm.
basically never got anything from the lender. And it was, I think, a year, or there's like some statutory or some sort of like limit on it too, I think, for them, where it was like, hey, it basically just like
Right,
kind of came off the books completely. And I never
right,
heard
right.
anything from anybody. And I'm kind of like safe somehow through that process.
Yeah,
Uh,
that is
yeah.
possible. There's two separate time frames there. It's the statutes of limitation to file a lawsuit, which in most states is between 3 to 6 years. In Illinois, it's 10 years. There's other states that have longer time frames. In most states, it's 3 to 6 years.
Hmm.
But we were kind of talking about, that's what I call the coin toss approach.
Right.
Obviously, I negotiate debts for a living. I don't advocate that, not just because it's not going to become someone is not going to become a client, but it's because it's a risky approach. You really don't
Right.
know if a lawsuit's going to pop up a year or two down the road. But we do know with certain lenders that they're going to be more aggressive than others. We know generally larger balances are going to be targeted for more collection activity. And we know some lenders don't get very aggressive legally.
Hmm.
So a key bank
Yeah.
private student loan, it's unlikely to ever experience legal action on a key bank private student loan, just
Hmm.
grabbing one example, even if it's a larger balance. So with other lenders, it's a coin toss. With Sallie Mae and Navient, it's generally a matter of time for a lawsuit if it's at least 50,000 or over. I've seen accounts as low as 24,000 go to a law firm with Navient. So you just don't know what's going to happen the next month. And I prefer a more proactive approach. But the other downside of that is the other timeline you have to deal with, which is the credit reporting timeline. So that will be on your credit for 7 years past the date of the first delinquency that led to the default, or 6.5 years from your default date. Now, the official term for a default is a charge off. Having an unresolved charge off on your credit reports is going to cause problems, whether it's a year in or 3 to 4 years in. It's going to cause some issues with any kind of approval for anything. So that's the other downside of trying to wait it out that long. But it does happen. I mean, I've heard of it happening on larger balances, but it's not very common. If somebody's moving around a lot and they can't track them down to find, where they send the account to a law firm, like which state they send it to, that can be a factor that plays into it. If somebody leaves the country, if they're not going to go sue them overseas usually. So it is something that people do. And again, I call it the coin toss approach. It's
Right.
probably less than 50% chance you're going to be successful, but people do write it out by doing that. But if you've got a larger balance with a major lender, there's a good chance they're not going to let you get that far to get past
Right.
the time frame for a lawsuit. Even if you do, you still usually have a few more years for your credit to have that account fall off.
Yeah, the damage over the long haul is probably not worth it for the vast majority of people. Um,
Right. And if you settle, I mean, that zero balance is a really powerful way to rebuild your credit just from that, the settlement itself. So we've had clients that have had increases in their scores from 50 to 90 points just from that zero balance being reported after the settlement is paid off. So that increases your numeric score, but it also shows any other lenders that you had a default, but it was paid or settled. And whether it's paid off in full or settled, that's kind of a common misconception that one is way better than the other. But according to a Credit Karma study, it was like a 20-point difference, whether you paid off
Wow.
the entire amount or settled it. So it's really the late payments that cause the damage and an unresolved charge off. So whether you settle it or pay it off, either way, it becomes a zero balance. Either way, your score goes back up. And that's usually the start of rebuilding your credit when that happens. So if somebody wants to get a mortgage or something and they have a defaulted loan, they're going to try to wait, 6.5 years until they can make any credit-based decisions or even start to rebuild their credit. But with that said, some people have done that successfully, but there's no playbook for that, unless you know the lender's behavior really well. But there's only a few lenders that aren't going to ever try that. KeyBank is one of them. I heard of a $330,000 account one time with KeyBank that this guy just never got a lawsuit on it and just waited it out, which if it's that big, maybe I would do the same thing, But there's a couple like really non-aggressive lenders, and there's a couple lenders that will sue on a $2,000 balance, Discover, the National Collegiate Trust, they're coming no matter what size the balance is. So it's just tough to gauge that as an individual who's, again, reading those anecdotal situations on Reddit, a one-off situation you don't have all the context for versus looking at the trends, knowing lender behavior, and knowing what to watch out for. But also we talked about previously, when it goes to a law firm, even if they're not licensed in your state, but especially if they are, assume that lender is sending it to a law firm for a reason. Like they will eventually go for a suit, probably sooner than later.
If and when somebody gets sued, what is the next step at that point? Is it just, oh shoot, we have to go to court? That's like the end of the situation, or what happens at that stage?
There's still a way to settle and work something out because, again, the lenders always want to settle versus clawing back a little bit at a time with wage garnishment, even if they're successful with that. With a lot of states, there are limits on collection activity, whether it's wage garnishment or property liens. Certain types of income are exempt from that, like pensions and Social Security. So they still have that incentive to settle even when they file a lawsuit. But debt collection lawsuits are so common. The courts are flooded with them across the country. It is a bully tactic in itself because once a lawsuit is filed, you have between 20 and 30 days in most states to file a formal legal response. If you don't do that, they automatically win a judgment against you. And that opens up the door for the forced collection activity. But if you file your legal response, which there's a great company called Solo Suit that will, for like $200, file your response for you. And that will buy you another 2 or 3 months to negotiate a settlement or a payment plan. Because the lender is hoping that you either get scared and make a payment or settle for a terrible percentage. They have all the leverage once a lawsuit is filed. The other thing to really avoid, which I see sometimes, is somebody got a lawsuit, they were scared, they called the law firm, they got bullied into signing what we call a stipulated agreement or a consent judgment, which means they're going to make monthly payments on the full balance forever until it's paid off. If they miss one payment, that lender automatically wins a judgment against them. So it's just a bad situation to be in because then you've removed any possibility of negotiating because you miss a payment, they get the judgment, they're going to go right for trying to execute that judgment with wage garnishment or something like that. But if somebody gets sued, first of all, you don't want to ignore it. And a lot of people statistically do ignore them and they get these judgments. And then like somebody will call me up and say, oh yeah, I've got a private loan and I want to settle it. I'm like, okay, well, tell me more about your situation. Well, I'm getting my wages garnished. Okay, so you've already been taken to court. They won a judgment and they executed a judgment against you. You need an attorney to try to even reverse that, let alone settle. And that's because they didn't respond. But once you file that formal legal response, and this is not legal advice, by the way, but I have done this myself. I've been sued on a debt collection account myself many years ago, responded and went to court and negotiated with the attorney in court before our session. Which you don't always have to go to court is another thing. People are scared of that. They're intimidated by it. It is an intimidating process. It was even for me. But you don't normally have to go to court. So you just have to file that response. What I would say is a good playbook is there's two routes to go. One, get a good debt collection defense, consumer defense attorney right away, have them handle everything, or file the response yourself through something like solo suit, either negotiate on your own or with someone like me, which I can get involved in a non-legal capacity to negotiate once that response has been filed. I can't do the response or help them with it. But if they file it on their own, I can continue to negotiate for a while because that puts the ball back in the lender's court. They have to do a lot more work now. They've got to do a lot more legal paperwork. They don't want to do that, you know.
Yeah, they don't want
So
to pay their lawyers.
right. They're assuming everybody gets scared and pays up or they get a judgment. If you kind of fight back a little bit and file that response, it opens up another chance to settle. And if there's still no settlement within a couple of months, probably time to get an attorney at that point. Because there is, there's only so far you can take that because they know you're not being represented by an attorney if you go through solo suit. So then they know, okay, we have to do more work. But once we do that, they don't know how to respond to our motions for this or our motions for that. That's when you do need an attorney once it gets further into the weeds after that point. But then if they actually want a judgment, we can settle those too. I settle those fairly often that, people get those judgments, they reach out afterwards. The legal process is basically over. It's a non-legal negotiation. I just have to make sure they file the response or the satisfaction of judgment with the courts once the judgment's settled. But it's like that time frame in between when the lawsuit is filed to when they actually win it or it's resolved that I can't really represent anybody legally. I can't negotiate in a legal capacity because there's a negotiation process and also a concurrent legal process that has to happen at the same time.
Got it. And how much time is there typically? Because I think, like you said, the courts are often backed up with this. I went through my own kind of legal thing a while back, and I was just shocked at how long the legal system takes, not necessarily even just with the courts, but with between lawyer and all of these
Yeah.
different little pieces, right? And
Mm-hmm.
I'm curious, from when they get sued to, like, say they have the 28 days to file and response, like how long is it on average before they actually get to a point where they're needing to go to a court, if at all? Because I'm guessing that's probably a long time, and that gives you that timeline and window to negotiate. And I'm
It
sure
does.
the lender doesn't want to be in there for a long time either.
Right. Yeah, they're kind of taking a hit by having to pay their attorneys, the attorney fees hourly. So they also get paid, the attorneys get paid a percentage of what they collect. So it's kind of a
Mm,
combination of that. But it really depends on the state, the county, even. Depends on the lender. It depends on how sloppy the debt collection law firm is. So once the lawsuit is filed, you've got usually 20 to 30 days max to file the response. After that, it could
wow.
be a couple of months until a court date is set. Um, had kind of a funny story recently where an ex-girlfriend of mine got sued over a small $6,000 Sally Mae loan that was sold to a debt buyer. She reaches out and I'm like, don't worry, like we got this. Like, I'm going to help you. Obviously, we ended on good terms and everything. We're still, maybe not friends, but on friendly terms. So I was like,
Mhm.
yeah, I'm going to help you with this for sure. So they tried to serve her. They served the papers to somebody she doesn't even know in her building. And they realized they had improper service. They tried to serve her again. And like, they've just not given her the documents to properly serve her. And I was like, well, let's just wait and see if they can, you know, fix their situation or if they're just going to like forget about this and it
Yeah.
gets dismissed because that's a possibility, which they may try to refile. But it's like, I even sent my authorization form that she had signed to the law firm. And normally they're going to call me like a lot if they get that form. It's like,
Hmm.
here's someone who's going to potentially get a payment into us or a settlement. They haven't called me at all. And I was like, do you want me to keep doing this or we can just kind of wait and see if they get their stuff together? And that's what she wanted to do, which I kind of agree with actually in this situation. But it's like, you at least have to properly serve this person for us to respond, and it's been
Right.
over a month. And it's, you call into the law firm and it's like a bunch of, people think when it's a collection law firm, there's a bunch of attorneys looking at every file. It's just a bunch of non-attorney debt collectors. The attorneys are just signing papers. They've got
Right.
their paralegals taking stuff to the court. The attorneys are just signing everything, and That's it.
Right. Right.
You do negotiate directly with the attorneys fairly often, but normally for somebody just calling in, you're going to get a non-attorney debt collector. And I remember the guy that taught me how to negotiate, a guy by the name of Eddie Bradford, good friend of mine who kind of got me into the business. I had mentioned earlier I met a guy through the church I was going to that had a debt settlement company when I lost my job back in 2009. And he taught me a lot of what I learned initially about credit reports, debt settlement, one of the best negotiators I've ever met in my life. And he
Really?
always said, don't get intimidated by the law firms when I was starting out negotiating. Like, it's just another collector. Don't be intimidated by them.
Yeah. Wow, that's great advice. I'm curious. One of the things you talked about a bit earlier, but it sounds like it maybe happens within the law firms as well. Was do these collectors get a commission for the rate that they're able to negotiate? So, like on their end, are they not just fighting for the bank's money and trying to keep the lender's money, but like are they getting usually a percentage of that as well? So they're looking for their own commission and deal out of that
Oh,
personally.
absolutely. Yep.
Yeah.
I don't know what that amount is, but they are very much incentivized by the amount that they can collect. So much
Mm,
so that I know debt collectors at some of the major lenders that were managers, like they did so well to be promoted to be managers and went back to
hmm
being debt collectors because they were so good at it. They were making more
Wow.
money as a debt collector than as a manager. So
Wow.
absolutely. And the good ones, I mean, they're in that for their career. They do that every day, 8 hours a day for 10, 15, 20 years or more.
Wow.
So somebody calling in, trying to feel things out for the first time, they're going to know how to press your buttons and say stuff that you don't know the answer to, just take advantage of that knowledge gap. I'm not sure if
Yeah.
I mentioned this story yet, but when I was negotiating on one of my own accounts, this was early on when I was maybe doing this for a few years, and I had been digging out of my own financial hole during during the Great Recession and the pandemic as well. But first the recession, and then just getting laid off after that. So I had a few accounts that went to collections, and remember calling one collector, and I was like, yeah, like I do this for a living. Let's just get down to business. They're like, well, we just called your mom. I was like, okay. And they still could press my buttons emotionally, even though I was doing that as a career for several years at that point.
Yeah.
And it's just different when you're doing it on your own. It's like it is more emotional. And that was one of the few times I've used some, extreme language in a negotiation. Because I just kind of went off, and then it's like that's the response they wanted. They got an emotional response out of me. They got me thinking out of a logical mindset into an emotional state, and that's what they're going to try to do every single time. And some of the good ones will act like they're your friend, that they're working with you. Be extra cautious about those ones because they know that that's the way they're getting paid and collecting, and they might make it sound like it's
Right.
a great deal. There's probably more meat on the bone in most cases,
Hmm.
but
Got
I'd
it.
say probably the majority of them like the kind of bully tactics, even if it's delivered in a soft, caring tone.
Right.
They're going to bring up the legal action, the threats, and you just don't know for sure what that time frame is if they're being serious.
Right.
And we talked before too that I don't always know for sure if that's legitimate or not. We have to kind of feel that out just with our experience. There are times when we know for sure that it's false. There are other times where it's like, well, we don't really know for sure what's going to happen next month. So let's lock in something this month and eliminate that risk. And that's a big part of
Yeah.
our approach is, not letting especially bigger accounts sit in default for too long because sooner or later that is going to become a real threat. And like we were
Right.
just saying, there's still a chance to resolve it. Once it gets to the legal stage, the settlements are going to be a little bit higher. They have more leverage. It's just more difficult for everybody. So it's better to settle before that happens.
Hmm. Got it. And with these bully tactics, and it sounds like often even lying or at least
Oh
stretching the
yeah.
truth in various ways, like, are there any protections for the borrower in situations like that? Like, if they are aware of, like, hey, you're doing XYZ thing, this is illegal, da da
Mhm.
da da. Like, are there any ways for somebody to protect themselves, or is it kind of just that those are just it's like the Wild Wild West kind of thing.
There definitely are. It's a pretty heavily regulated industry at this point.
Hmm.
The Fair Debt Collection Practices Act is one of the major laws that governs debt collection. And there was just an update that's called, I think it's Regulation F um, in the US Federal Code that had a new set of compliance and rules for debt collectors. Because I would talk to some of them, this was like 2 years ago. They were all getting ready to implement that. I think it was starting in 2022 or 2023. But there's a lot of debt collection outfits that will kind of break the rules. And if they get caught and fined, it's a cost of doing business, because they're counting on the consumer to not know their rights.
Right.
And it can be something just on a collection letter. The first letter you get from them when they have your account, there's a number of things that could be wrong on there. And there are attorneys who specifically go after just those kind of violations for $1,000 a pop plus attorney's fees. So
Right.
in some cases, if the violations are egregious enough, you can get so much back for those violations that it pays off your collection, basically. But people just don't know about that. And debt collectors, they have to tell you they're a debt collector when they call you. They have to say this is an attempt to collect a debt. Any information obtained will be used for that purpose. They always say something related to that phrase every time you call them, or at least they're supposed to. With texting and new technology, that kind of blurs the lines a little bit. So they have to still tell you they're a debt collector when they text you. There are limits on when and how they can text you. They can't call you or talk to you after 9 o'clock at night, your time. There's different things like that I feel like the larger agencies that I deal with, they're getting big contracts from big lenders. So they're a little bit more by the book. Some of the smaller ones, it is more of a Wild West kind of thing. Some of the debt buyers, especially on the credit card or medical debt side, these smaller accounts, they might take a little more leeway in how they interpret the law. But it's the knowledge gap that people have of, was that a violation or not? And unless you've read the Fair Debt Collection Practices Act, which is this thick, it's tough to really know for sure. But one thing that social media has done, I think, is kind of level the playing field. And there's a lot of nonsense on there regarding debt relief. There's scammers know they can get on there and the validation scam we were talking about, where you send a couple letters and say, I'm going to get your debt deleted with a couple of validation letters. Those kind of people, some of the credit repair scams, which there's good and bad credit repair companies as well. They can do that on social media and get away with it, right? So they're not going to be looked at as closely, at least they think that, by the Federal Trade Commission as maybe something on their website. But there are a lot of debt experts and credit experts who I would never have found, but TikTok knows now to show me that kind of content because that's what I post. So I've seen a couple that, it's like, wow, this is really informative. And there's a few people that really specialize in just those violations. And that's their whole business, is hitting those debt collectors for those violations at $1,000 a pop. So
Wow.
It's something where we have more visibility of that now. And hopefully that, that knowledge kind of spreads. But in general, debt collectors get people on the phone. They're already in a heightened emotional state and they don't know the laws or the specifics of the laws and how that pertains to them. So I think a lot of that kind of falls by the wayside, and people just don't know for sure if they if they can do something about it. Like you said, the bullying stuff, it's like it's a little different. It's you can talk to somebody in a mean way on the phone that's legal, and if they're not specifically breaking any rules or any laws, then they can get away with it.
Yeah. Plus, you need the evidence, right? Like if you're on one of the challenging things always about a phone call is, unless it's recorded or there's some sort of evidence and all that kind of piece,
Right.
it's kind of hearsay at that point, right? They can just say, no, I didn't do
Yeah.
that. And then there's who is there to back it up?
Right. And with recording calls, I mean, people have to be careful because in some states it's legal to record a call without the other party's consent. And in some states you need the other party's consent. So you can look up, it's called the Federal Wiretapping Regulations. Back to the good old wiretapping days. But in Ohio, it's a one-party state. You only need one party's permission. You just need your own permission to record a call. So I've had situations where I've told a collector, like, hey, I'm recording this call too. Well, you don't have permission. I don't need permission. I just gave myself permission. This is a one-party state. and they're like, oh crap, whether I'm recording the call or not. Sometimes I'll just say,
Yeah, no, put somebody else on ice a little bit, right? Makes them
right,
play a little bit
right,
softer, a little bit more careful. No, that makes
yeah.
sense. It's a
They're
good
they're
tactic.
usually recording calls on their side. And I think the laws are a little different if it's a company, but they will tell you that they're recording the call. Sometimes they'll ask your
Right.
permission, sometimes not. They're usually going to record that call in some capacity,
Hmm.
but that's for their own internal use. Like, unless
Yeah.
you take them to court or they take you to court, you get your attorney to force them to provide that as evidence in the discovery process. That's never going to see the light of day on your side of
Right.
things.
And I'm curious with the variety of like bad acts that somebody might see, especially somebody like you who is doing this stuff in and out and every day. And it sounds like the maybe larger institutions, like you said, are playing more by the books, which is the vast majority of the people that you're also seeing are from these
For me,
larger
yeah,
institutions. So you're not
yeah.
necessarily seeing a lot. But I'm curious, is there would there ever be a possibility you think of, I don't know, some sort of larger class action pushback, either with regard to some of the legality of the stuff or just stuff that you've seen, where I feel like even somebody in your position, you're like, oh, I'm collecting kind of, negotiation after negotiation after negotiation of these
Mhm.
behaviors, and then, positioning yourself with a lawyer with, hundreds of people who have settled their debt or gone through things to kind of push back against these companies in sort of a larger, more organized way at some point. Is that something you would imagine ever happening?
Yeah, that's a good question. Once the settlement's done, it's kind of like I think people just want to walk away from it and just not have to deal with
Sure.
that again mentally. Like there was one
Yeah.
point, I think it was sometime earlier this year, where I think I had emailed some older clients asking for reviews, like from a year before. Didn't hear back
Yeah.
from anybody, like 7 or 8
Huh.
people. It's like, even though they had a great experience with me, they just, they're like, no, I'm not dealing with that anymore. It's over. Um, but as far as like the class actions, it really takes like an ongoing abuse of the different laws and the different regulations in place. I don't see as much of that because when I get involved, I stop the calls. So a lot of those situations come from harassing communication to the workplace, to family members, um, you know, just to that person, 10 or 12 times a day. The original lenders or the lenders are allowed to call a lot. Like they have more ability to do that in most states. There are some states that have their own state version of the Fair Debt Collection Practices Act, the wide
Hmm.
ranging collection laws, and they've made those laws apply to original creditors. There's like 7 or 8 states that have done that. California is one of them, I believe Massachusetts, and there's quite a few other ones. I think maybe even Florida. Um, so there is a way to stop those harassing calls. And even with Navient, for example, they're a lender. They don't have to stop the calls, even though my authorization has a cease and desist letter built into it saying, you know, under FDCPA section 805C, you are required to cease and desist all phone communication except to this person, which is me representing the client. And even when they get that letter, they don't have to comply with that in a lot of situations because they're an original or a lender. If not the original lender, it's usually Sally Mae before them. But they'll do it anyway out of just kind of, I want to say, respect or just, that negotiation relationship. But if a third party debt collector gets it, it is a legally binding cease and desist letter built into our authorization letter. So I'm stopping those calls right away. So I'm not hearing about persistent ongoing harassment once I start negotiating. So I just
Right.
don't think I see a lot of that. And they're not really doing anything with me on the phone that's
Not
illegal. Or
crazy.
I know, like I know around my ways around that. I know how to push back on that stuff. So a lot of times they won't even try it. The debt collectors
Got
that
it.
try to talk to me like I'm a borrower, it's like, dude, you're a rookie. Like, how long you been doing this? Because you build relationships with someone like me, you're going to bring in more money. You're going to have to come low enough, but I'll have a settlement for you every time. So
Right.
I told this one guy the other day, he had bullied one of my clients into making a payment, got her on the phone by herself. She didn't tell me that he was calling her. I was like,
Mm.
hey, communicate. That's like the most important part of this process. But every once in a while, that kind of stuff happens. And um, he bullied her into making a payment, made a false deadline, a lot of the stuff we've talked about, a payment by Memorial Day. And I talked to him. I was like, dude, we've done deals before. You're tripping over dollars to pick up pennies. You're trying to get these little
Yeah.
payments. We're trying to settle for thousands of dollars into your office by the end of this month. And then I kind of used my leverage to talk to the manager and say, hey, this dude is being really disrespectful to me and my client. I've got a long-standing relationship with you guys. I know we're working for different sides, but we've brought in a lot of money to your office. I don't want to work with this guy on these two accounts this month. I want you to pull those from him, and I want to work directly with you. The answer was okay.
Wow.
So this guy was telling me to know my role the last time I talked to him. And it's like
Wow.
anytime a conversation gets that personal, it's not productive on my side or their side. So why don't you spend your time bullying other people, and I'll work with somebody else on your files? And hopefully he learned a lesson from that. That
Yeah.
I've been doing this long enough that I'm not gonna let something like that stop me in my tracks. Like, I've got the relationships, I've got the leverage. I'm bringing in the amount of collection revenue, really, is what settlements are, over and over and over, that I can pull some strings too. So it's not very common anymore. A lot of my early negotiations were just I had one where 15 minutes straight, me and this guy just screaming at each other for 15
Wow.
minutes, and neither of us hung up, and we're just going at it. Those days are mostly over, but every once in a while, it's like I gotta put somebody in their place, and it still is a battle. It's still adversarial
Hmm.
at the end of the day.
Yeah.
A lot of the negotiations are cordial with people that I know very well, but every once in a while, it kind of reminds me that this is a renegotiation of the original loan terms. The lender does
Right.
not want to really do this. This is an adversarial process. It's not calling up and asking for a lower payment. It's very different.
Right. And you said something that was really interesting to me, which is, talking about the fact that you have these relationships with somebody who is also competing against you, right? And
Yeah.
that's a really unique and interesting dynamic. And I
Hmm.
guess I'm curious, and I don't know if you've ever thought about this before, but how has that changed or shifted your perspective on humans in general? Like when you see things that are going off in like the global stage, for example, right? There's a lot of conversations about like the US and Russia or the US and China or all these different kinds of pieces that are just happening, right? And there's these very
Hmm.
large entities that are on opposite sides of a situation, and yet they're also working together somehow to find a solution to these different problems. Like what is being a debt negotiator in this perspective kind of taught you about humanity and the way that we do things?
Yeah, negotiation is something we all do in life, and debt negotiation is just a different type of negotiation, and a lot of the principles are the same, whether it's negotiating on an auto loan or with your landlord, or two countries negotiating. Obviously there's a lot more variables there. I don't think I've really thought of it in a global perspective, but I guess if I'm doing that now, I guess if I would think about that, it's like there's usually always a solution,
Hmm.
and maybe not a compromise. Sometimes there can be a win for both sides. It's not both sides are giving up something, but it's not that both sides are taking a loss. Like there can be a win-win, and the least worst option to resolve things. And at
Mhm.
some point there's mutual interests that overlap at some point.
Right.
And that's what I think about when I talk to all the debt collectors that I know. It's especially the ones that were almost on friendly terms. It's like I know we're on different sides of the table, but with them, it's not that it's more like a collaboration, is what it feels like sometimes.
Hmm.
They're going to
Yeah.
work hard to get me a low settlement because they know that I'll have it. And I've done 30 other deals with them, in the last couple of years. So there are times when it feels like a collaboration, but we never forget who we're working for. I'm working
Right.
directly for the client. They're working directly for the lender. So yeah, I guess just that, if there's communication, there's a chance to resolve something. When communication's cut off, just like anything else with in relationships and in business and people's personal lives, when there's not any effort to communicate by one side or the other, you've lost the chance to have any kind of resolution. But if you can keep talking, even if it's difficult, you might be able to work something out.
Yeah. No, I think that's a beautiful perspective. And I think great advice for people who are wanting to work something out in general. But I think even looking at the larger picture, it's fascinating to think about, because there are people on the sides of the political aisle who have these relationships that are negotiating on various things, and there's a lot of this dog and pony show that maybe a lot of us see, that we see on the outside of things, but we're not really also privy to those private conversations that are kind of actually moving things across the needle, and these people who have really good established relationships. And it's fascinating
Mhm.
for me to hear from your perspective too, just how valuable those relationships are in keeping things at bay and at peace and allowing things to move smoothly, right? Versus the
Right.
further away, the more disconnected we are, the more that we do all of this posturing and the bully tactics and all this other
Right.
stuff
Yeah.
because
Yeah.
we're trying to get something with somebody that we don't really know. Versus once I know you, I'm like, well, I'm going to settle at 40 to 50%. We know this. So let's like get to that place. Let's have a good relationship. Let's move forward because we're going to be doing this for a long time. Right. And there's a win-win for both
Right.
sides.
Yeah, and I'll tell my clients, like I was telling you before, we've got 6 clients with a major lender this month, and they're each assigned to different reps, different collection agents, but
Mm-hmm.
I'll work with the manager and the director also. So
Yeah.
kind of concurrent communication with both sides, with both parties. And there's a couple of the agents at this major lender that we're on really good terms. It's like one of them will like tell me a lot about what's going on in their company and these different trends and kind of inside information that I don't think they get in trouble for saying that, but it's like
Hmm.
super helpful to know for me.
Right.
And it's helpful. It's helpful for them, for me to know it, because I can, work better with my clients that I have with them. But it's a very, very friendly conversation, and I'll tell my clients, like, your accounts with one of my long-term contacts at this company this month, that's going to help our negotiations. But you know
Right.
people have so much animosity for some of these lenders, and for good reason. Like you were saying before, you've got 100 something thousand at 18%. You've paid 80,000 and you still owe 100 on 60,000 that you took out 15 years ago. It's
Right.
very, like, that's a very common scenario. At
Wow.
15 or 18 or 14% interest, they've dealt with all the other, idiots up to that point in the pre-default departments who have maybe called their workplace, called their family, said some stuff to them. They have a lot of animosity towards these lenders, and I
Right.
recognize that there are, those bad actors, but it's like at the end of the day, I'm not getting involved in that emotional sense. But if I told some of my clients, like, oh, your account's assigned to so and so, and like I would go have dinner with this dude and shake his hand if I saw him. Like, this is my guy. We're gonna get a great settlement because this is my guy. And
Yeah.
you get on the phone. It's like, hey, how you been? How's your month going? And maybe they wouldn't like if they knew that it's that friendly sometimes, but that's what's getting them
Right.
this really good deal. And that's not with everybody, but it is with a good number of these collectors that I've worked with long term. And they
Mm-hmm.
recognize, like, that's their best way to get the deals done. So I send over 6 authorizations earlier this month. My phone starts blowing up. It's like daddy's handing out presents at Christmas time. Oh,
So
we got an
funny.
account with Andrew. Oh, we're going to get a settlement. They're all blowing up my phone. I don't even talk to him for the first week.
Wow.
Um, just kind of let them, simmer a little bit. But by the time I do talk to them, it's like it's very cordial. It's friendly. It feels more like a collaboration. And yeah, maybe my clients, with just the level of animosity they have towards these companies, maybe they wouldn't fully understand that's what happens over time with these kind of relationships, and this is what's getting
Right.
you this really good deal. It's also my strategy, but it is very much based on the relationships too. And if
Right.
anything comes up that's an obstacle, if anything goes wrong, to fix that and smooth that over and resolve it, it's also based on those relationships, and for them to
Right.
not screw things up in the first place, as well.
Mm-hmm. Yeah. It's fascinating because I think even in this conversation, right, a lot of we've talked about like the lender and or the borrower in these cases, and a lot of how we've talked about it is the sort of the lender as the bully and the borrower as the victim in a situation, which certainly can be true. And I think it's also really important, and something you're shining a light on is like that other person is a person, right? They have fears and insecurities and
Right.
relationships and a life and
Families.
kids and
Yep.
all of these
Yep.
other things going on that are just like you and I do. And I think something that you do so beautifully well that you demonstrate here is remembering that, and remembering that, like, hey, this person's a person, and like they ultimately want more or less the same thing that anybody else does in life.
Yep.
And just the value of relationships in that regard. I'm reminded of, have you ever read Never Split the Difference?
I've heard of it, but I have not read it.
Okay, so it's a negotiation book, and it's written by a
Right.
guy who I think he teaches or taught at like Harvard, but he was an
Okay. Yeah.
actual like legit like hostage negotiator, and
Okay.
did
Yeah.
other kinds of negotiation as well. And one
Mhm.
of the things that struck me, which I found to pretty much always be true when you really look at a lot of the masters of like negotiation or influence or just positive change in the world, even, is the importance of empathy with any of these pieces, right? And
Yeah.
he
Absolutely.
talked about, working with the FBI and having to coach them, and because so often they are so like, this person is just evil, blah 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 person. There might be 100% truth to that, and he's like, if you can't empathize with their actual position, if you can't put yourself in their shoes, if you can't sort of care about them in a genuine way, you're not going
Yeah.
to lead to these positive results without some
Right.
sort of significant conflict.
Yeah. That's interesting. I just did a video the other day about empathy on
Hmm.
TikTok, and it was stitching a Dave Ramsey video. And it's one of my major problems with Dave Ramsey is he takes kind of a bullying approach on the advice side of things. And
Hmm.
yeah, tough love has its role, but he was wealthy by the time he was in his mid 20s. I'm not sure if he ever went through any significant financial hardship. Maybe he did,
Yeah.
but he was wealthy by the time he was 26 from real estate, and he's not slowed down since. So maybe because he's not been in some of those situations, he doesn't have that sense of empathy. And I think that's important for any good financial counselor to have that, because it really helps you think of your client as a person too, and to feel for their situation. I think this career has helped me become more empathetic for sure.
Hmm.
We hear about all kinds of different hardships, and I've talked to the parents of someone who committed suicide over their loans.
Wow.
That was one of my toughest conversations. I cried with them on the phone,
Wow.
and that was one of the most extreme. But there's a lot more within that spectrum. I've got a client right now who's got stage 4 cancer, that just came out of nowhere. It's like, hey, settlement is not your most important thing to worry about right now. Like, I'll play defense and just battle this thing and fight your fight and keep me posted. And
Yeah.
if we want to settle down the road, we can. But we hear about a lot of different things like that. So we will talk about that in the negotiation as well with a hardship letter. And I think, kind of going back to what you were saying, like having that empathy for the debt collector and having that relationship with them person to person, it also kind of gives the hardship story a little more oomph, maybe because we're already kind of on that wavelength. And now I'm talking about my
Right.
clients' issues and with someone who I have a good working relationship with. I think it maybe helps that hit home a little bit more. But yeah, I think that's very important in negotiations and just financial advice in general. But having empathy for the other side, is an interesting perspective, and I guess I have developed that too. But yeah, they are people just like us, and nobody probably grows up saying, "I want to be a debt collector when I grow up."
Yeah.
Doubt that many kids are ever even knowing what that is or saying that. Um, but they found themselves in that career, just like I found myself on this side of the career, that industry, without really planning for that either. I'm not sure how many kids say I want to be a credit counselor when I grow up. Um,
Right.
but but yeah, it's humanizing the other side, and especially like you were speaking, like politically and globally. I think there's a lot of tendency to demonize the opposition, to look at them as not a person, and yeah, that obviously leads people to do things they otherwise wouldn't do if they could see their opposition as another human being who has the same needs
Yeah.
and struggles and desires that they do.
Yeah. I mean, that's one of my hopes with how global our world has become, with particularly with social media, but also just, I mean, I think about it often that the idea of dual citizenship, right, in two countries is becoming
Mhm.
so much more common because
Yeah,
people are traveling more and meeting somebody and marrying them. And like, I'm so fascinated just how our countries are all going to evolve over time. But I also think that it's a big factor in limiting war, I hope, because
yeah,
there
yeah.
are so many citizens of other countries in other countries. And
Right,
not just
yeah,
in a mental way, but in a very visceral way with, you're seeing, oh, I'm watching my daughter in another country on Instagram or whatever it is. And
right.
you're like, I'm not, we're not sending people to war. I think there would be a lot more outrage. I mean, obviously we have some really horrendous wars that are going on right now, but I'm hopeful that that continues to, be a inspiration for peace, I guess would be the right word.
Yeah, and a way to kind of connect us. And yeah, I think, social media is definitely a double-edged sword, and I've had to
Mm-hmm.
get used to just being on it and knowing that I need to be on it to grow my business and to kind of spread my message and help people.
Mm-hmm.
Um, so I've had to kind of get used to on a personal level of just the pros and cons of that. And I've gotten more used to it, gotten more comfortable with it. But yeah, I think, the societal issues from social media that we have, and there's a lot of negative correlations with negative trends with health and teenage depression and suicides and stuff like that with the rise of
Mm-hmm.
social media. But there's also, the way that it's making us all much more connected and seeing each other on a level playing field. And seeing a video from somebody in China or India or some other part of the world, and just seeing them as a person, just like they're seeing us
Yeah. Yeah.
from that
I
first person
certainly,
perspective too, like not on the news
mhm.
or not, it's that
Right.
first person video.
Right. Yeah. You're seeing the human, right? And I think that makes such a big difference. While we're on the topic of career a little bit, something you said much earlier was, and you talked about not no one grows up wanting to be a credit counselor as a kid. And you talked about that, this is kind of your contextual purpose, but you didn't feel like it's like your big purpose. And I was curious about like what, if anything at this point, do you feel like is your larger purpose in life? If you, and it sounds like you believe in purpose. So what would that be for you, you think, if you have one?
Yeah, I'm really not sure.
Mm,
I would say having a bigger impact and helping more people in a different way. I'm not sure what form that would take,
mm,
but it's one thing that, from just doing this, it gives me such a sense of purpose that I'd want to keep doing something like this, but having a bigger impact. And maybe it wouldn't be in the financial space, but that's kind of the niche that I have now. It's the tools that I've developed. And yeah, I don't know. It's like once you grow a business big enough, then you have the resources to have a bigger impact too. So I think that once you get to a certain point, that can branch into a lot of um, different areas of nonprofits or philanthropy and things like that.
yeah.
So I'm open to discovering what that's going to be. I don't think I know what it is yet.
Very cool. Um, Out of curiosity, with pursuing that, you mentioned that it would possibly be something like out of the financial. If you were just going to, I don't know, take a wild swing, like what are some of the things that do interest you outside of the financial sector? And we've talked so much about student loans and all these other pieces, but what are some of your
Yeah.
other passions or dreams, or like what are the other things that kind of motivate you or inspire you in life?
Well, I grew up in the woods and definitely been a big outdoorsman my whole life. And fishing, kayaking, conservation, kind of wildlife conservation kind of blends in with those hobbies for a lot of people. And
Very cool.
really enjoy just getting on the water in my kayak and just zoning out and fishing a little bit, mostly catch and release. I will keep a couple fish for dinner sometimes, depending on what kind it is. Love to travel. Been big into fitness and martial arts for a long time, and I think that kind of that discipline and that that aspect of I don't know combatives, learning how to fight a little bit, that mentality is something I've taken into this line of work too. Um, but I don't know, I'm a fairly simple guy, I guess, with my interest in pursuits. I like to travel. I like to be outdoors, fitness and nutrition. And I don't really have time for a lot else at the moment. So it's either doing that stuff or working and building the business. Um, Spending time with my family and friends, of course. But probably my biggest thing is just I love seeing new countries and experiencing different cultures. There's just nothing like that for me. And I've been able to travel a little bit and still work while I'm traveling, which is nice. I haven't really taken maybe a full week off for a vacation in another country in a long, long time. But I just went to Quebec City a few weeks ago. Just worked during the week, just like I would here in Ohio, and got to be in a different setting, very European feeling, very francophile French speaking
Yeah.
province. So that also kind of gave me just a different perspective on business, and you just get different insights when you're taking yourself out of your current environment. So one thing I really like about being able to work remotely and work from my own office here in Ohio is I can just take that show on the road with me, and done that a few times, and I really enjoy doing that. So just being in a different place, even if it's a couple hours away, you get different inspiration and you're looking at things differently. Just working on a laptop versus my computer monitor sometimes is like a different feel too.
Hmm. Yeah, you mentioned that like working in Quebec gave you different insights or perspective on business. What are some of the takeaways that you got from that shift?
Maybe not specifically like inspired by that culture, but just being in a
Hmm.
different country and being out of my little comfort zone here, walking around quite a bit, taking some stairs up the cliffs they have there almost every day. Um, just maybe thinking long term. I think that's probably the biggest thing is I get out of my routine. I'm thinking longer term about my business goals, where I want to go with this new chapter of the business. I mentioned before, actually, I think it was kind of off the record, but we almost went out of business during the pandemic because
Hmm.
there just was no demand or not enough demand. And for a while, interest rates were low on private loans. Lenders were pausing payments like they were on federal loans. And then all that ended and the interest rates shot through the roof. And now we have a real
Yeah.
crisis in the industry. And I've had to learn social media marketing and posting and all that to try to get more visibility, which has worked pretty well. And people have found us, quite a bit more. So we're really in kind of a new phase of the business with, we've got two employees now, part-time employees that are helping with counseling for evaluations and also just kind of administrative stuff. So that's been like it was like whiplash, honestly, from like last year to maybe for several years before, and then up to like last fall. And I hired a really good marketing and social media coach, Laney Media, and they really helped me turn things around and just understand how to really present my offers and the value that I provide in the best format on social media and some other things too. We got a great Google Ads person, so we're running some ads to kind of get the message out there as well. But it's just felt like such an accelerated phase, and it's been a great great shift and a great change from just trying to figure out what's the way forward with the business. So just reflecting on that, it'll be about a year in August that I really set the main things in motion to make this happen. And I was taking a pretty big risk at the time. I didn't know if it would pay off, and it was a little scary. I mentioned to you I took out a business loan to fund that expansion, and it
Right.
was it was a risk, but it paid off. And it's I think reflecting on that was something I was doing quite a bit when I was out of the country in Quebec, and yeah, just being able to go walk through the old city. It's a very beautiful city in Canada, probably one of the most beautiful. Then coming back to my Airbnb and working for the rest of the day, just taking breaks and getting out and getting, not thinking about anything business related and letting those kind of inspirations just kind of come to me or, you know, subconsciously even, and then kind of develop that versus sitting there thinking like, what's my insight from this? It was all very
Right.
much
Right.
just kind of, yeah, kind of floating in, I guess, at different times when I was just out and about.
Yeah, kind of picking it up through osmosis and being in that
Yeah,
different
that's what
change
I
of
was looking
setting.
for. Yep. Yep.
Yeah, yeah, awesome. Well, that's rad. Thank you for sharing all that. Um, yeah, Andrew. I mean, this has been just such a wonderful conversation. It's been really, really awesome getting to know you and chat with you. I guess like one other question that comes to mind: if you weren't doing debt settlement, like or anything in the financial sector, like what do you think you would be doing?
Good question, man. I'll say sometimes that in an alternate universe, I'm still in Florida. I didn't get laid off from the courthouse job. I became an attorney, and I was like maybe a prosecutor or defense attorney
Hmm.
or something. I don't know. That's probably the track it would have gone because I really thought
Yeah.
I'd work in government for my whole life. I was looking at going to law school down there already and kind of thinking that through. By the time I got laid off, which was only a month into the courthouse job, my interview process was longer than the time we were
Mm,
actually there. We laid off all the new
wow.
hires all at once. I was already like, this is kind of boring. Like, maybe this is the way to go. But I
Yeah.
probably would have stuck with it if I hadn't got laid off. Like I would have, there were things I liked about it. Obviously, so structured and but I was in the felony appeals department. So I
Hmm.
was reading about the worst things human beings do to each other in Florida, which,
Wow.
pretty bad.
In
Um,
Florida, you got a lot of that.
but I liked the process. I liked working within the court system, maybe a little bit of the prestige of it. But
Hmm.
I was also, it was maybe a blessing in disguise because I was already thinking, I don't know if I really want to do this for the rest of my life. Like that's what everybody else is
Right.
doing. You work your 25 years and retire and get your pension and that's it. But
Yeah.
I would have probably gone to law school, which I don't really want to do anymore. I like knowing attorneys. I know a ton of student loan and consumer defense attorneys. Again, just kind of building those relationships. If there's somebody that's too far into a legal situation for me to help that reaches out, we've got different places to refer people. But don't think I'd want to do that for my day job. I like having a little more freedom and um, you know being able to kind of branch out into just this negotiation space.
Yeah. I mean, it's interesting that it sounds like you're pretty drawn to very technical and competitive jobs. Not necessarily competitive in like, rising up the ladder, but like part of what you do is compete with somebody. Is that like an
Hmm.
accurate, I mean, you mentioned doing martial arts. Is that a pretty accurate portrayal of your position and what you
Yeah,
kind of enjoy?
I'd say so. Like I really like just kind of the challenge of having to fight for something like that and having to compete and not knowing for sure we're going to get a deal, but knowing that most likely we will. But I've got to
Hmm.
still go through the process. And again, it's like every time I get a settlement letter, it's still that feeling that I had 15 years
Right.
ago when I got my first letters for settlements. So yeah, I'd say that's definitely pretty accurate. Wouldn't say I'm too competitive in maybe other areas, but I definitely have a competitive streak in certain things in martial arts and even like competing with yourself, right? Trying to be a better version of yourself every day. That's
Hmm.
probably I'm the person I compete with the most probably. But yeah, I do definitely enjoy that, and because of that, the cycle of collections and settlements and the end of the month pressure we were talking about, my month will ramp up from the beginning to the end, where the first half is it just feels lighter. The second half gets more intense, like workload wise and just everything, the feeling of it. I'm locking in, I'm in the office, 10 hours a day sometimes. And then it's the end of the month again, everything's over. The payments come in for the settlements get paid, and then we start over again. And I kind of like that variability versus like doing the same thing day in and day out like I was at the courthouse. I like
Hmm.
having that different rhythm and having that challenge and having part of the month be way harder than the first half. I like that actually.
Okay.
Now if you ask me that on like the 25th of this month, I'm not going to say that I like it because it's going to be pretty intense. But looking at it now, from a distance, I do like that rhythm and that flow of the process. So I think if that was just a day-to-day thing and it was a normal job, I probably get bored more easily. And if there wasn't something to to battle or to fight for, to compete for, or to win, I think I would also, yeah, I don't think it would be the best fit for me.
Yeah, no, that makes sense to me. It sounds like you're really driven by. You probably aren't super competitive in other areas of your life because you get that thrill, if you will, from work. So you,
Yeah,
fortunately, it probably doesn't have to bleed into other areas. And I've seen people who
right,
probably could use that and bleeds into other areas of their life where it's not not so useful.
right,
Um,
yeah.
well, Andrew, I mean, again, this has been such a fascinating conversation, and it's been wonderful getting to know you. I know that we did this earlier, but just to do it again, like if people want to work with you, find out more about you, keep in touch, like, and if you have any, or any requests from the audience, the floor is yours.
Yeah, I mean, the best way to reach out to us is through the website, mycreditcounselor.net. We are very active on social media, like I was saying too. So on TikTok, my handle is Andrew Weber CCC. If you search for private student loans on TikTok, you'll probably find me at some point. And on the rest of our social media, it's mostly My Credit Counselor is our handle.
Hmm.
And yeah, the website's probably the best way to go. We've got a lot of information on just what to expect, different examples. We've got 46 reviews. They're all 5 stars on Google. So you'll find those also on a pop up on the website, and just more of what to expect and to kind of, educate yourself on the process to see if it's a good fit. Which whenever I talk to someone and they're like, yeah, I've been researching forever, it's like awesome. Like I love an educated, caller or client. It just makes things easier for everybody. And again, if you don't know much about settlement or whether it's right for you, we're more than happy to explain all of that as well. But doing a little bit of research ahead of time can just kind of help you figure out whether it's the right fit or not, or whether you even want to jump on a call and go further.
Yeah, absolutely. And awesome, Andrew. This has been wonderful. And I will put a link to his website and social medias in the show notes and the YouTube description, etc. So make it easy for anybody who's looking for the help to see it. Again, I can't recommend Andrew enough. He helped me settle a ton of money and get me out of a lot of student loan debt. And he helps people every single day. And if you are looking for any help in that situation, definitely reach out to him. He is a godsend and doing important work. So, again, Andrew, thank you so much for coming on the show. It was a blast, and look forward to staying in touch.
Yep. Thanks, Cameron. It was a blast for me too, and really appreciate it.
Yeah, my pleasure. Have a great rest of your day.
You too.